what he's signaling. क्या करना है? Oh, okay, okay. The red switch. We'll just take 2 more minutes because the webinar is about to start and a bunch of people are waiting online. So I apologize, but we'll take 2 more minutes. Piyasha is just going to switch it on.
Recording in progress.
Just a couple of housekeeping things before we start. Tea coffee is going to shut down in 10 minutes. Before, if any of you want to run and get a tea coffee, do that right now in the next 2 minutes. Then it'll get shut down. We are moving according to a strict schedule, and so there will be a timer here. Azhar will be sitting here. So whenever the sessions are about 5 minutes to close, then Azhar will be announcing that he'll put up a little cardboard that there are about 5 minutes to go or 1 minute to go. So we'll stick to that timeline. Dr. Amar Patnaik, who's the keynote speaker, is about to come in about 5 minutes. And I request you all, we'll have a quick break at about 12 o'clock or so. So it'll be a 15-minute tea coffee break. I request you all to come inside right on time. We want to move according to schedule. There'll be an announcement outside at about 2 minutes before we end that break. So, and for lunch also, yeah? So thank you very much. Any other logistics to be covered? Nothing? Okay, all right. Can we just call the entire team? हमारी टीम है यहाँ पर? ठीक. Okay, my name is Sumit Swaroop. I'm the director for India Development Foundation and for the Center for Digital Future. I'll tell you what the relationship is as part of my opening remarks. IDF was set up in 2003 by a number of very renowned industrialists and Professor Shubhashish Gangopadhyay. It was set up in 2003 with the intention of doing research. And in the last 20 years, we worked on over maybe 70 or 80 programs, initiatives, and projects. And we've been quite successful at it. We have a decent name in the ecosystem and in the country. In 2019, we set up what is called the Center for Digital Future because we believe that the digital economy of India needed a special focus. So anything to do with digital is taken through that program. But legally, India Development Foundation is the organization. We are a trust. And within that, we run a few programs and projects. Within CDF, which is the Center for Digital Future, we've set up a program called the Initiative on Choice, Competition, and Innovation, which is essentially the conference today, the competition conference. So we look at competition issues around the digital economy, around innovation that we are doing. So that's a setup for today. Now, what we do is we do economic research. I get asked many times that what do you do? Advocacy karte ho, policy karte ho, think tank ho. And the concept of economic and autonomous economic research organization is so rare in India that people take some time to fathom that this can be done actually. And India has somebody like this. So we are neither affiliated to an academic institution, neither are we a policy advocacy, which is a euphemism for what. And neither are we a think tank because think tanks tend to again take a very strong position. There are less thinking and more tanks, and there are many layers to that where you have various plays and fundings, etc. So We are very different from that. We are an economic research institute. We are autonomous. We stay independent. Our views are independent, objective, sometimes controversial. Sometimes we do hear, huh? Many times wrong, yeah, but always there. So we are very proud of the work that we are doing. We tend to be non-partisan and say things as it is, and that's the area in which we would like to grow. Very importantly, we are independent and not affiliated to anybody. The most important thing for me, and I'm the director, I'm not an economist, I'm not a scholar. So the most important thing for me is the people, because especially in the area of research, if you build a team full of good people, that's when you grow. And it's not just intellectual. I actually don't know what intellectual means. I know what intelligence means, but I don't know what intellectual means. So I'll come to what all we are looking for, because this is a conference of academics and scholars and PhDs. So I'm not trying to sell a project, which I would do if there were sponsors around. But here I am going to talk more about collaborations and recruitment and working together with all of you. So that's what I want to talk about. I want to start by introducing our wonderful team, without whom this will not be possible, of course. And we've grown a lot in the last 1 year, starting with Dr. Nishant Chadha. He's a PhD from, oh, don't clap. You'll be really clapping a lot in the next, in the next 5 minutes otherwise. We'll clap in the end. I know it's a fantastic team. Dr. Nishant Chadha is an IIT Kanpur engineering graduate, and then he did his PhD in economics from University of British Columbia. He's been with us for 6 years. Before that, he was with SNU for 3 years. He's got about 10, 12 years of work experience. He leads at IDF, CDF, he leads our competition practice, and he's the academic lead for today's conference. And he's really put in a lot of hard work in the last 3 weeks. I actually didn't realize how much work it takes to put together an academic conference. Dr. Kamlesh Kumar, he has so many degrees to his name that I actually lost track yesterday when I was chatting with him. So I lost track. So I said, Kamlesh, I'll do it my way. I don't want to spend like 10 minutes talking about your background. But he's got degrees from ISI Bangalore, University of Paris, MPhil from Tilburg, and PhD in finance from Durham University. I think he worked he studied till the age of 40. But no, I think he's much younger. His interest and specialty is quantitative economics, statistical models, mathematics, and data. And he loves to work around that, irrespective of the sector in which we are looking at. So it could be any sector in the economy, it could be any private public sector especially, he loves to put together the data and do some deep analysis around it and do statistics around it. For us, he's working on a very, very important project. I can't tell you much about it, but the research paper is due to come out in September, I think. Yeah. We'll send you all a link to it, and then you can see what the capabilities that we have. Dr. Vatsalya Srivastav, right there. He has a PhD from University of Tilburg, and he's currently also a faculty at Jindal University. His interest is, again, competition. He's done some work with Nishant in the competition field. A lot of technology, actually. He also does some work with startups and the areas. So impact of digital economy, I would say, that's his broader interest. And with us, he's working on a number of very broad range of topics, 3 or 4 projects where he's going to produce white papers, 10 or 12 page white papers, and then they can proceed into maybe a research paper and a deeper understanding of that particular issue. Dr. Abhay Gupta, he's actually not here, but he should be on the webinar, so I'm going to introduce him. He's also an engineering graduate from IIT Kanpur, and he's got a PhD from University of British Columbia. And he's finished programs from Harvard and Columbia University. He's worked at OECD in Paris, House of Commons in Ottawa, European Investment Bank in Luxembourg. And with us, he's doing a very good project on e-commerce. Next is Jaydev Dubey. I think Jaydev Dubey has gone to receive, he's the सबसे tall guy, and the thick beard guy. He does not have a PhD, but I can tell you his intelligence and capability match or even beat many of the PhDs around. He's got about 12 years of practical work experience. He's got an MPhil in auction theory from JNU Delhi. He's sometimes a little diffident about not having a PhD, but we always remind him that you don't always need a PhD to do good research. And I'll tell you why 2 minutes later. His interest in theoretical and empirical research, he's a published researcher also. With us, he's going to be working on a secret project on electric vehicles. He just joined a month ago, so I think next week we'll start on electric vehicles with him. Dr. Isha Gupta. Isha. Raise your hands, Isha. Okay, there's Isha Gupta. She joined us about a month and a half ago. She's got economics from Madras School of Economics, PhD from the University of Padova in Italy, and 2 years of postdoc research experience. She's also working with us on e-commerce and also doing a couple of other assignments with us. Dr. Azhar. Dr. Azhar has an MPhil and PhD from JNU. He's interested in health. He's worked a lot on empirical work. With us, he's working on the area of jobs. Piasha, there we go, Piasha. Piasha is a research associate with us. She's got a master's and a bachelor's degree in economics, and she's worked at Ashoka University, from where we stole her a couple of months ago. Her research interests include trade, industrial organization, and environment. And she wants to go for her PhD maybe in about a year or two. And Ritu, finally. Ritu is who holds our entire team together. She looks after finance and admin and keeps the numbers straight for me. And yeah, keeps everything organized. She is the go-to person in the office. So that's our team. And of course, our Professor Shubhashish Gangopadhyay. He's our mentor and research director. And we all look up to him, and especially to me, he's a mentor. So that's our team, and now you can clap. So like I said, we are looking for collaborations. We've expanded a lot. We're doing a lot of interesting work. We find that India and the industry and government need somebody like us, which is not already there. We are building something different. We have a conviction. We are idealistic about it. We were tempted that this conference should be a 300 people conference and we should invite anybody and everybody, but we said no, 40 people, focused conference, only academics and researchers, a few select industry maybe. So we are a little bit idealistic. We are striving towards a vision, and we are getting there. We're making fantastic progress in the last 1.5 years. 4 things we look forward to when we recruit people, and for every 20 interviews, we hire 1. We've done some hectic recruiting between September of last year to now, and it's a continuous process because people and culture is a continuous process. The first thing is a positive attitude. You can do it, you will do it, you'll drive till you're tired. Welcome, Dr. Patnaik. We're just doing a few opening remarks. 4 things that we look forward to is, the first one is a can-do, will-do attitude, a very positive thing, right? That you have to have, because we are driving towards something, idealistic. The second thing, you have to have a curiosity about the world. I'm not an economist, but I have a huge curiosity about the world. I've learned because I ask lots and lots of questions. If you have lots of degrees, but you're happy to sit in your area, then you're not for us. We need curiosity. You need to be able to ask questions of the world around you, because economics ultimately is about the world around you. It can be as mundane as, how does this mic work is a science question. But how is it priced and where does it come from and what is the supply chain of it is an economics question. It's as mundane as that. It's as mundane as looking around your house and wondering how things work. Where did this come from? Why can't this be replaced by that? Why did that policy happen? That's an everyday curiosity that you have to have. Third, general intelligence to get to a goal. That means that if you have a vision, if you have the strive, then you should have the intelligence to navigate the obstacles to get to that. You should know that, okay, if I'm doing a research, then I need to have these 10 steps in place to get to my goal, and you iterate on an everyday basis that, okay, this is not working, I'll try this is not working, I'll try this. That is what intelligence is, because that is how we are different, right, as human beings, as intelligence beings, that we know how to overcome our obstacles and get to a goal, and that is what we look for, intelligence to get to your goal. And fourth, of course, some degrees will be nice. If you don't have a PhD, that's absolutely fine. But if you have the other 3, that will far override a PhD. You can learn the models and you can learn the data and you can learn those things. You can pick it up within a few months. You can study at night. But if you don't have the attitude, the positive attitude, the curiosity, and the general intelligence, then perhaps we are not the right place for you. But if you are, and you have that drive, please come and talk to us. I think a lot of you know Jaydev here. That's Jaydev. He's the tall, bearded guy who I was talking about. He's a classic example of doesn't have a PhD, but he's actually more capable of things than a lot of PhDs. So a lot of you know Jaydev. Please come and talk to him. Express your interest. There's Isha. There's Azhar. Please talk to people that you're interested. We are setting up a good culture and organization. We are setting up full-time work, part-time work, freelance work, remote work. We just need you to be there with us. Yeah. So whatever your case is, if you want to do a small project of 1 month, 2 months, a white paper, you want to do some field work, we have expanded a lot. We have a lot going on. So please talk, right? But we have to have these 3. I say 3+1 characteristic because degrees don't matter. All right. I think that's it I had on my recruiting drive, at least. All right, unless until there are any questions, which of course can be discussed outside. I would like to move on and introduce Dr. Patnaik. Welcome. Dr. Amar Patnaik is a member of parliament in the Rajya Sabha from Odisha. In the parliament, he's a member of the finance committee. He represents the Biju Janata Dal. He's also the party's national spokesperson and head of the party's IT wing. Before becoming an MP, Dr. Patnaik had a long and illustrious career in the Indian civil services. Welcome, Dr. Patnaik, please.
Morning to all of you, and thank you so much. Apologies for the delay. First of all, how are you? First of all, I wish I had heard to this introductory speech earlier, because I really struggled to get a PhD after joining the civil services, and I took a study leave of 3 years and then a year in Kennedy School, and the writing part was the most difficult, and finally managed to get a PhD, and that was converted into a book by Palgrave Macmillan. That's on institutional change and power asymmetry in the context of rural India. I have been working in the tech space for a long time, in the sense that when I was a member of the Indian Audit and Account Service, right from the 1990s, I used to be looking at IT systems. I used to be an IT auditor, having audited not only big systems in India, but systems of the United Nations, the FAO, right, even at their headquarters, in their peacekeeping operations, at Rome, in the headquarters of FAO, and in Afghanistan. So IT, the evolution of IT in general, and in India, the adoption of IT, the diffusion of technology. I have followed it up with a lot more interest than my core profession, which was auditing other systems as well, evaluation of systems. So it helped me really to get into this space, even after taking a voluntary retirement from the service and joining politics, and be in the finance committee, where we look into, strictly speaking, finance committee is to look into several things, including the economy, the finance. But as you know, technology is now all pervading. It has got into every sector, and therefore in the finance committee as well, we discuss a lot on, for example, we just finished a discussion on cyber laws, cyber crimes, cyber incidents of cyber terrorism, and a report would be due sometime soon. Now, today I thought, since it is, I was told, I had the last interaction with him in the dialogue meeting a few days back. I was told this is extremely scholarly audience, and therefore I thought I would indulge myself into discussing a little bit of understanding what's happening in this space, purely first from a theoretical point of view, and then how it's happening. Let me also have this caveat that I'm not an economist. I'm a physics graduate, but all my economics is during the course of the service, as well as largely during the time of PhD, because it was an extremely interdisciplinary PhD that I was doing. Why technology is important? I do not get into it. Just suffice to say that in 2009, I have data which says that in 2009, the 10 top global companies had one technology company. Now come 2018, just after about a decade, in this top 10, there were 5 technology companies. That's how they are influencing decisions in this world. And therefore, it is very important that we discuss technology. Now, we discuss technology. Today's topic is competition policy. So in the context of, the context is digital economy, technology, data, the digitization, the digital environment ecosystem that's growing and growing at a very, very fast pace, new emerging technologies, the proliferation of data, as they say, is the new oil. And in this background, the behemoths that have come up in this world, the big tech companies, remember when we were doing our MBAs, at the time we used to study the impact of multinational companies in a number of things. That used to be the discussion. Large amount of discourse used to be in that. Now it's the impact of big tech in policy making, in competition law, in agriculture, in insurance policy, agriculture policy, fintech, financial technology services, all over. Now this is the context, and then we look at competition. Normally, the neoclassical economics would tell us that you want competition basically to discover the most efficient price. Most of the big tech companies are giving you services at 0 price. So what is the competition about? What is it discovering? So I have a thought on this. You may agree, may choose to disagree. We can have a conversation on that. But the fact is that 0 price products and services by technologies czars are now ruling the world in every sector. You give even in, let's say, agriculture, you give a service to the farmer, you give a loan to the farmer, you give an equipment to the farmer, 0 price, 0 interest, this kind of stuff. So what is it discovering? 0 pricing doesn't mean 0 cost. 0 cost, in the sense, it's not 0 cost to the user of the technology. So two variables are coming up. One, the information cost. Information is a variable. And the other one is the attention span, attention cost. The entire ecosystem or the entire business models of, I think, all technology firms, big tech companies, centers around these 2 variables. I would think so. And these, when I say about information, as it is understood, the more information that they have, it gives them more market power. This information comes from data. The more attention they can have of the user, gives them more power. And then they build the network effect around these 2. So the 2 things, these are the costs. But what is it that is being discovered? I had prepared some notes after a lot of thought, and these 2 variables, I thought, is innovation competition, and this innovation coming out of data. The second is the competition that's taking place because of, linked again to attention, is the amount of mind space. What is the time that the platform or the technology is able to occupy of the user. how much of is linked to attention cost. Now, if you look at innovation pricing, if innovation is the thing, which is a good innovation, is the most efficient innovation, which is the best innovation, which can meet user needs, which better solves the problem of society or a particular category of people, that's where the competition is taking place. So a competition law, which was traditionally looking at whether there is improper discovery of price because of whatever measures by the various actors in the competition field, that has now shifted, and that has shifted to how good is the innovation. But since this innovation is driven by data in the digital space, so what has come to occupy the centerpiece, or this crucial thing, the centrality of this competition ecosystem, is access to data, processing of data, storage of data, use of data, data everywhere. So anybody who has a control of this data, just as they would say in oil, is actually a monopoly. But unlike oil, which is rival, excludable, data, strictly speaking, is non-rival, can be non-excludable, can be excludable as well, can be excluded. So finally, what is happening is that these big tech companies are operating in this excludability and non-excludability portion of the data. And that's where the competition is happening. So any competition law will have to address this core issue. We keep on saying dominance is not bad. We can't stop dominance. But abuse of dominance is bad. That's what the competition policy makers, lawyers, I'm a lawyer myself, we have been talking about this. Here I want to share whether it is possible, how far it is possible by way of a regulation. It's a double loop. We are operating in a system of a double loop in which a player who has a large amount of data of users has an automatic advantage of using that data to give better service, innovative solution to its users. And also uses the data to advertise to advertisers to foster their goal. And the resultant effect is these advertisers are investing more money in order to get more data. So there is a double loop which is working. And this double loop gets reinforced every moment when they are able to catch the attention of the user. So a competition policy, if it has to address the issue of bringing fairness to the system, it has to address these core issues. What is the problem there? The problem there is, let's say, startup. A startup may have a brilliant idea. A startup may have a brilliant idea, but ideation is not enough. It has to be bettered. The ideation has to be first proved by data. The robustness of the ideation would depend how well it is able to explain several such situations or several different situations. And that can only happen if you have more amount of data from these people. Now, this is where the problem is. The data is all with these people who already are having large amounts of data in the double loop system, and they are increasing the quantum of data over a period of time. They are able to exclude people from using that data. They are knowing fully well that data is non-rival. So excludability is the entire business model, and therefore you have self-preferencing, bundling of services. The network effect gives them the additional advantage. So our competition law, when it addresses abuse of dominance, and so this gives them dominance. All that I have spoken to gives them dominance, and this dominance gets reinforced over and over again each time we use this. Their algorithms becomes better because more amount of data is coming. The generative AI that they are using would still become better. A startup with a better solution, a better algorithm, may not even have the data to improve it, may not even have the data to use it to prove and get some solution solved of the users. Now we, while doing any regulation, we always keep on saying, and particularly more so in India, because we say, our policymakers, all of us say, that we should not over-regulate. We should not kill innovation, because we have a thriving ecosystem of startups, unicorns. We have a thriving ecosystem driven by young people. The demographics are such. But this is where the problem is. The entry barrier is tremendous. And when we say that this is a great innovation, this is an innovative solution, and market capitalization has improved, whatever, it's just by using this data. So if you restrict the use of data, innovation itself will suffer more for the startups rather than for the big tech companies. And that is why in governments, or at least in Indian government, we are very careful, and I am particularly careful in all committees. Day before yesterday, Google was there with us, Apple was there with us, we are discussing this. But then the entire model that they operate is based on data. A user would like to have a product, preferably at a zero price, as I said, and who can provide that? It is these big tech companies. So monopoly is now built into this ecosystem. I don't think we can have a system in which we can completely remove it. All that we can do, and that's what I tell the Competition Commission of India when we are discussing the amendments to the CCI recently, that our entire understanding of competition, the competition law was framed when there were physical markets. Now when we have digital markets and digital ecosystem all pervading everywhere, we have to look at competition from this angle. And data has to be a key, has to come into the framing of the regulation. And therefore, when we say that you are antitrust, your policies are antitrust, anti-competitive, you will have to take data into account. When you are saying your deal value should be this much, this is the new amendment that we have brought in the Competition Act. This deal value should be able to somehow quantify or factor in the data availability data should feature in the scheme of decision making to decide whether it is an anti-competitive thing or a competitive thing. And therefore, when Gopal Krishnan committee, I was a member of the Personal Data Protection Bill. At that time, the Gopal Krishnan committee came. Krish Gopalakrishnan talked about non-personal data, metadata. And he categorized it as, one is the personal data, of course. The other one is community data. And another one is data for everyone. There has not been much discussion on that report after that. There was a committee which was set up. But I think that is where the solution probably lies to some extent, to reduce anti-competitive policies of the big tech companies, antitrust policies, and improve competition. How this would happen? That the data which is at the core of innovation and core of the business model somehow has to be made available to the other players who are probably startups and decrease the entry barrier for all of them. Now, whether, in what manner this should be made accessible, what would be the cost of it, who will ensure it, are questions which have to be addressed. Unfortunately, we have had several rounds of discussions with the Ministry of Corporate Affairs Secretary. I don't think this is being addressed. We are having a solution which is very cosmetic, which is easy probably to regulate, but very difficult to actually reduce anti-competitive practices by these big tech companies. Not just big tech companies, anybody, including government, which is the largest data fiduciary. It has the largest amount of data. Now, in technology, there's a way around. That is, you make the metadata available in public domain. Therefore, we have the Open Government Data Initiative. But you know, in the Open Government Data Initiative platform, portal, a lot of data is there which is dated. A lot of data which is there which is not current. A lot of data is there which is not relevant. For example, I went and asked the Secretary of Revenue the other day, you said that compared to 2014, which is of course for this government that is the benchmark, and now this is how the tax buoyancy has changed. This is how the tax collection has changed. I wanted to see the trend. I wanted a 20 years data. Even though I'm a member of the Finance Committee, this data has not been made available to me. Even though in private conversation, yes, it is there, it is there, it is there. I keep on telling this. So this availability of metadata to every player is one of the ways, in my opinion, to spur innovation and at the same time not make it excludable by the big tech companies. This particular aspect must get into the calculation of deal value. This must get into the decisions that are taken by the CCI. And I think the carve-outs, one way of doing it is to have carve-outs for startups and MSMEs. But the carve-outs won't work well unless it is globally, the metadata is made globally available. That's one of the recommendations of the Krish Gopalakrishnan Committee report. Unfortunately, we have not really taken it too much forward. The need for protection of privacy related to personal data would apply to everyone. The model that we follow for ensuring this, following EU GDPR, European Union General Data Protection Regulations, has been to build a lot of compliances upfront to ensure that the data principal, the user, has the right to give data or share data after consent, and several data portability, data eraser, data minimization, many things are there. But the problem is, I'm not getting into the issue of informed consent and all that, that's a separate chapter altogether. But here I'm saying from the perspective of competition, these compliance costs, even though the big tech companies are also making a show of saying that this is too heavy, this will kill innovation, what is actually happening is that this will kill innovation at the ideation level by the startups and the MSMEs. So if you have a regime of data privacy, data protection is very important, because that's now a law of the land in India after the Puttaswamy judgment. So it's a part of fundamental rights, Article 1921, everything is there. But the compliance cost would be much heavier as a proportion to their revenues or proportion to their capital for the small startups, for the MSMEs, where new ideas may germinate. So the model for data privacy, again, data privacy cannot be looked at in isolation from any law that we are making now. That's my view. Unfortunately, that is again something which is not permeated in the people who are making policies. So even if you are making competition policy, data has to be taken into account to determine the deal value, the market power, the network effect it builds, how is the bundling of services done? It is network effect plus data. Now, if you have a regime of a data protection law or privacy law, which instead of building a high compliance cost upfront, shifts it to a model in which huge penalties and fines or other kinds of things are imposed at the end of the thing in case of a violation on a base, what I call, I have written about it extensively, is the harm model. In the harm model, what you do is that if a harm has been caused to a data principal because of using his data or misusing his data or in an irregular way without his consent, then you will have to pay a heavy penalty for it. In that case, it will actually probably act as a deterrence for the big tech companies. It will not affect ideation and innovation for the startups and the MSME sector. Fortunately, after several discussions, I find that the new law, which they withdrew the earlier law, which was completely based on EU GDPR with a lot of cut and paste, I think the new law, which they put it up for public consultation, not yet introduced, and I was talking to the minister just yesterday, this shift they have tried to bring in by building in huge penalties at the back end if there is a harm which has been proved. How to ensure what is the harm, what is the quantum of harm, what will be the scale of penalty. Now, these are issues that will have to be discussed later on. These rules have to be made. This is a separate aspect. I'm also not getting into how good is the privacy law when a lot of it is through subordinate legislation. That's a lot of it will be implemented through delegated legislation. I'm not getting into that. I'm on the topic of competition. Now, this is the entire theoretical construct that I put before you for a competition law in digital system or digital economy, which would actually cater to the twin purpose of not killing innovation and at the same time increasing user needs or user satisfaction, and at the same time protecting his privacy. A second point which I thought I'll discuss here, share with you here, maybe I'll write about it later, is, again, it's an economic concept, and that is of bounded rationality. Herbert Simon, when it says that there is this bounded rationality for the rational human actor operating in the neoclassical paradigm. With the advent of generative artificial intelligence, generative AI, and being used in almost every algorithm and more aggressively by the big tech companies because of the power they have, because of having the largest amount of data. I didn't talk about data storage. Data storage is another issue in which, again, the big tech have more power over the startups. So what happens is innovation only gets limited to these people, remains within that space. You might be tweaking here and there, making some amount of effort at improving the regime, but the question would remain whether data is available to everyone. That's one part. Now, on the other part of bounded rationality and use of generative AI, what has now happened is that human actors, rationality, whether it has been constrained or its limits have increased because of the very innovative generative AIs that are continuously coming into the market or into the digital ecosystem. Now, this is important from the competition angle, because ultimately a competition commission consists of human beings. It consists of people who will be evaluating whether there is an anti-competitive practice, abuse of dominance. Now, when technology is driving this to a point where there is no limit probably to rationality, the algorithm itself is driving it, and they are able to do this. How efficient and how better, how efficient and impactful would be the decisions of the Competition Commission of India, manned by human beings with bounded rationality, is something that would play out in future. The third point which I wanted to make on the front of in the area of a possible improvement in this entire digital ecosystem will be two concepts which I have spoken about in an ET, Economic Times digital conference in Bombay, is data minimization and purpose limitation. These two things. Now, data minimization and purpose limitation are concepts which have been borrowed from the EU GDPR. It is there in the Puttaswamy judgment, which has relied heavily on the EU GDPR concepts. Data minimization protects the user not just from his privacy issues, but also from misuse of his data, abuse of his data. But the other side would say that if you stick on to this principle too fast and too hard, then innovation would get affected, because you need more data for innovation. So this is the balance. This is the conflict, the friction. These are the friction points. And this I am saying, if someone, since there was a marker for me that where is the evidence, these are all evidence which are recorded in the parliamentary committee depositions which has happened over the period of last 3 years that at least I have been involved in the Personal Data Protection Joint Parliamentary Committee and in the Finance Committee for last 4 years. Many of it probably has not come out, but questions on these have been raised. Some of, initially there was reluctance from the big tech to participate in this, to depose before these committees, because there's no law which requires them to depose. But then, for example, Google, day before, yesterday, they came after, I think, 5 or 6 reminders. So, and then we have heard the Indian innovators, what is the kind of competition they face, and also the big tech. The Indian innovators, compared to the startups, are big. So startups also have a grouse against them. But it all centers around this data, bundling of services. There is a view which is there, which is that if using this data, bundling of services and everything else, the user is getting a benefit, what is your problem? Because zero priced. Whether your job as a regulator is to protect the interests, or rather, let's say, to meet the needs of common citizens, or to protect your industry of, Indian fintech companies, Indian travel tourism companies, or at some level, MSMEs, NBFCs. Now, this is again another friction. These are layers which has to. So as regulators, and when we also prepare these reports, that this is how the regulation happens, you can imagine the kind of conflict that we have to deal with, the friction point. There are no solutions, there are no answers. But data minimization, I was talking to you about, is one way which is probably, it is the source. So if you reduce data availability, a lot of your problems get over, but a lot of new problems might come. If you increase it too much, lot of problems might get solved, a lot of problems might happen. The second is purpose limitation. You collect data and use it only for the purpose for which you have collected it. Who knows the purpose? The user may know only that much purpose which satisfies his needs. But how the data is going to be used, he has no idea, number one. And number two, and it is more significant, to be fair to these people, the big tech companies or to those data aggregators, they themselves do not know what this huge pool of data the machine would make relationships from and build algorithms which would probably be beneficial, may not be beneficial, may be way away from the purpose for which the data had been collected. It is not even able to tell the data principal at the time of collection of data that this is the only purpose for which it will be used. You can say, which was there in the EU GDPR and brought into our earlier act, was that at every stage of processing, for a different purpose, a consent should be taken from the user. That's the ideal way. But will it work? Will a regulator be able to enforce it? We have to also look at enforcement. In India, this is the problem. When it is so many years in civil services that we make great laws, great policies. Implementation is the key. Enforcement is the key. And in all this, when there are violations of the competition law, even if we make all these changes and try to bring a balanced competition law or a competition environment, if there is a violation, then will we be able to enforce? Do we know where the data originated? Do we know the original source of data? Because it has gone through several iterations and the machine has learned and the metadata at several levels have actually been created and used to cause probably, let's say, bodily harm or non-bodily harm, or some kind of a harm. So this is the problem also in purpose limitation. But this is a good way, again, this is like a tap, this is a good way of restricting the misuse and abuse of data to take advantage in a competition environment. I will probably end with this, but these are some thoughts which I had been there with me for a long time, and since this is a very elite crowd of people who would think on this, so I throw it open to you people to think about, ponder about it, and maybe get back to me on some of this. Some of these, of course, I propose to write in the coming weeks, so that some of it policymakers read, and some of it opinion makers read and think about this. In all fairness, it is not an easy riddle to solve. There are things which are built into this ecosystem, things which you can't prevent, things you can probably mitigate to some extent. And when you mitigate, that's the trade-off that you do. What would be the impact on innovation? Does it matter to a citizen if his satisfaction is met by a big tech or by a startup? For him, it is anybody who meets his needs and at a lower cost. The advantage is with these people. So these are crucial questions that have to be answered. So I'll end with this. Thank you so much.
Dr. Patnaik, thank you so much for this. This was, I think, such an absorbing. I think we were all focused on what you were talking about, and it was really, really interesting. And these are the kinds of dialogues that we want to have in the open, and of course, when we talk to you one-on-one. You talked about a number of issues. We actually don't have time for questions, but just a couple of minutes of wrap up. But you talked about a number of issues. You talked about open with competition, price, data, the theory of harm, data storage, boundary rationality, artificial intelligence, and you very smoothly covered many different topics. You talked about the data minimization, purpose limitation, enforcement through regulation, which I think is very important, and we've discussed it in the office multiple times, that how is the government going to enforce this and that. I think a couple of things from our side, and then we'll wrap this up. One, we would love to have you over in our office we'll invite about, of course, our own scholars. We'll invite a few other people. We would love to have a 2-3 hour discussion and a brainstorming and a controversial discussion off the record. We would love to talk to you about that. And that's an open invitation, so we can talk about when your availability is. I know you're very busy with the session in Parliament. The second is that, and this is not me trying to sell IDF, because we will do this for free, but how do we at IDF work with you, with members of Parliament, with the finance committee? Is there a place that where we can fit in and contribute to the national discussion?
This is what saddens me, because there's so much of a repository of knowledge here, and you're asking me this question. The government should have been actually reaching out to you to get your thoughts on these kind of issues who are working on this. That's really unfortunate. But then, precisely for this reason, I have taken the lead in forming a informal parliamentary group of MPs on technology. This is an informal group. Fortunately, I passed out from Delhi St. Stephen's College. So a number of Stephanians who are MPs are there on board in this across parties, and some of them who are with me in several committees that I am in. So this is a very eclectic, I would say, of group of MPs which I have. We can have you roped in over there to have a discussion on some of these issues, because they are very keen on this. Unfortunately, in the Parliament, we have a standing committee on information technology. This information, this fortunately we have, but unfortunately, they don't discuss anything beyond the MeitY, belong the Ministry of Information Technology. But as I said, technology, particularly the emerging technology, is something which pervades everywhere, which cuts across. Digital health is a big issue. It's not just privacy alone. And imagine the kind of harm that can happen to a patient. Wrong data tampered with. So, but then there is a separate standing committee on health. There is a separate standing committee on agriculture, but there is nothing available, a platform available. And standing committee on finance, we are supposed to be actually doing, discussing issues relating to the Ministry of Finance. And Ministry of Finance would mean all these 5 ministries of economic affairs and revenue and all that thing. Say, of course, Niti Aayog is there, RBI, SEBI are also there, but that's fintech. That's not agri-tech. So that is why I formed this group. And we could give discussions, because this is one thing which is available to MPs, that they can actually write to the chairman of any committee and make a presentation. May not be available to people outside, but this is what is available. So we have decided amongst ourselves that, like Shashi Tharoor was earlier in the IT, but he's not there. But now I think he's in some other. So we have discussed this. So this is where I think I can get you in. That's one question. There's a second question, and the first question is about the involved discussion. It's an absolute pleasure. Thank you so much. We provided I have the time for it, but I will find the time. We need to have this discussion, and we need to have this discussion not just within the academic world or within the technology players, stakeholders, but the policymakers themselves, who probably work with. I have been a bureaucrat earlier, but I'm just saying that the vision is very blinkered. They just because they want a quick solution, a quick act, a quick regulation, because they have to announce it to the world. How efficient it is in solving the problem at hand is never evaluated until they realize that certain portion of it is dysfunctional, and so they bring in a patch or what's a carve out through an amendment, which further vitiates the the objective of the act. Look at IBC. So many changes over there that there is nothing of the original IBC left in the original legislation of 2016. He is here, he knows it, and so that would be it will be a pleasure to get involved in this and try to improve, contribute to improving the system. We can get the people who are going to make the laws in here. Of course, they have these committees which ropes in the people from outside. The ex-ante legislation committee, which is looking into ex-ante legislation, the digital competition steering committee or something. So that one would probably bring in. But you know, in these things, always the pressure is what you want to hear. I always say that the consultative process is a two-way process in which you share, they share, you share, they share. What happens invariably, I've seen in government so many years, that you call a lot of people, hear from them, but then you decide what you want to keep it and what you don't want to keep it. So that will probably change if we can get them also in, and I'll help you in that. Thank you.
We will certainly keep that in mind. And with that, I thank you very much for your time and for this wonderful address that you gave us.
Thank you so much, and thank you to everyone.
We have Professor Shubhashish Gangobadhyay. He'll be leading a panel discussion.
If we can have the panelists up on stage, please. Where is Rajat? So while we are waiting for the third panelist, hopefully he's come. I didn't get to see him as yet. We have with us, let me just introduce you to Rahul Roy. He's a youngish lawyer. And he's also on the various committees on which is drafting legal policies. And we have Dr. Sahu, who is quite remarkable in that he has been involved with almost everything we are going to discuss today, because he's been in CCI, he's been in SEBI, and he's been in the in IBBI, or the bankruptcy board, right? And the third, Rajat Kathuria. He has worked a lot on technology and technology policy. In fact, he has spent time at TRI also. He has spent a lot of time at TRI. And now he's moved squarely into academia and is at SNU, Shiv Nadar University. So, where is the third panelist, Jaydev? Go. Okay. So let's get started. I'm going to start with Rahul, who is beside me. So I'm just going to follow this sequence. Rahul, we are, you know what the topic of the discussion is, which is competition and innovation, right? How can competition policy affect innovation? So since you have been in policy making, you've been a lawyer, you have practiced, I'm sure, a lot of competition issues you have argued. How do you think competition policy could affect innovation or is affecting innovation, especially in the digital space?
Thank you very much for having me here. It's a very academic setting and I'm a practitioner. But it's always nice to step away from my day-to-day routine and engage in these discussions. Before I answer your question, perhaps what is missing when we represent our clients before the regulator in active enforcement situations and when we engage with the government in policy making, what I've seen lacking is any discussion so far on actually the relationship between competition and innovation. Is that a linear relationship? Does competition always lead to innovation? Or can there be situations when innovation can lead to situations where competition is hindered or evaded? A lot of work has happened at the OECD on this issue, and they have concluded, as always, that there is no linear relationship. It's a complex relationship. Competition does increase innovation, but as we are seeing, and as Dr. Patnaik pointed out, in the digital world, innovation can lead to evasion of competition. It can lead to situations where a certain product or a market is captured largely by one or two enterprises. Now, if that's the complex scenario that we are looking at, which is that the earlier notion that competition always increases innovation is now being tempered with the idea that innovative product manufacturers or service providers can have runaway success, and which means that markets can tip in favor of one or two players, then are we looking at a situation where innovation itself has led to less competitive markets or markets which are less contestable? It's important to recognize that, and it's important to keep that in mind each time that we are, as lawyers, when we are advocating for our clients on policy issues, or when we are working with the government and trying to grapple with this question of what is the optimum level of ex ante rules or regulations are required on the competition side. Now, this takes me to the second question, what is or what could be the various types of innovation? In the traditional sense, in the brick and mortar economy, you had innovation on the production processes, on the distribution side. You had innovation on the product, which is that you add more features. You innovate on your production to reduce the price of the product. That's one way to look at innovation. The other way to look at innovation is that whether it is incremental or whether it's disruptive. And if it is disruptive, then can that disruption take us back to a situation where there is, for at least a foreseeable future, there is no competing product or service in the market? And if that foreseeable future is a long drawn period, as we have, for example, seen in the world of search engines, for example, or as we are seeing, for example, in the world of social media, then is there a role for ex-ante rules. Dr. Patnaik talked about preventing abuse of dominance. Ex-ante rules don't necessarily prevent abuse of dominance. They try and ensure that the actors are disciplined well in advance before that abuse can potentially happen. Now, if that's the idea of ex-ante rules, then what impact can that again have on innovation? I'll take two examples. Sorry.
Just one quick question. Since you made a distinction between incremental and disruptive,
Sure.
what do you mean by that?
Take, for example, the VCRs and VCPs of the 1980s. I was born in 1980s. When my parents got the first VCP, I started seeing movies on VCPs. Then we moved to VCRs. They were incremental. And today we don't use any one of those. The world has moved to streaming.
Why wasn't it disruptive? Because it killed the earlier product.
It added a feature. And
killed the earlier product and the earlier companies, right?
I see your point. But the real disruption has happened today. We don't need those instruments anymore to watch movies. We are relying entirely on streaming services. That has shifted the market. Very often the people who made VCPs are the ones who moved on to add a feature and converted that into VCRs. I take the example of Walkman. Walkman became a CD player, but the iTunes killed that altogether.
So you're saying that earlier it was the incumbents who developed newer and newer technologies, whereas now it's outsiders who are doing it, and in that sense it could be disruptive.
The same set of people who are disrupting the status quo, but in many ways the distinction between a VCP and VCR, for example, was a feature distinction. It wasn't a completely new system altogether. Streaming is a completely new system altogether. We have been accustomed to search through Google for the last 20 years or 20 odd years. If ChatGPT takes off, it has significant promise. It will be the complete disruption of the way search has functioned so far.
So
and
you're about to give two examples. Sorry, I interrupted you. Yeah.
So the one example was this example, as we have seen in the world of movie watching, VCRs, VCPs, and today they are gone. No one really, they are, and I don't think that we can find them in junk shops also anymore. That's one example.
We'll find them at our homes, in the attic.
We have, the second example, I talked about the search side of things. We are possibly looking at a significant disruption. But the question that the antitrust regulator has been grappling with, and we as practitioners have been grappling with, is that if the innovation is, if we consider that innovation can be disruptive, then what should be the extent of intervention, either ex ante or ex post? Should that intervention create disincentives for innovation? Now, and therefore it's important for us to understand the conditions for innovation. When do and why do firms innovate? There can be internal factors for innovation, but as I see, and I hear this often from the industry stakeholders who we work with, is that if the markets are contestable, which is that if there is an opportunity for someone else to enter the market, then people will innovate, add more features to their products, and try and spend that money on research and development and enter the market. But that's not sufficient, that's not enough. There has to be that opportunity for appropriation of the gains that come from innovation. We still continue to have a lot of socialist hang in this country, and therefore making money is seen as a bad thing. But unless we give that opportunity
No, Rahul, we have to stick to competition policy.
Sorry. I do, and that's where it's again, because competition is about, if we have to foster innovation, then we need to give the assurance to that entrepreneur to that engineer, to that lawyer, or to whoever else is willing to stick their neck out and take that risk, that you will be rewarded for that. We have figured out a way, and we have acknowledged this in our own legal systems. We are unwilling to acknowledge this in an express way when it comes to debate around competition law and policy, but our intellectual property regime is precisely this.
Exactly.
It's a regime where we realize that innovation has to be fostered. For that, we need to provide a mechanism for the innovator to reap the gains. And therefore, the statute confers, with limited carve-outs, the ability to appropriate monopolistic profits that arise from that innovative technology for which someone has secured a patent. For 20 years, you have the ability to monetize that technology, except in limited situations of compulsory licensing. So with this, the question that I throw up for discussion here, and
I'm the one who throws up.
sorry, but for you to
you give the
consider,
answers.
Yeah, happy to answer, but that's the challenge here is that in any design of ex ante rules, it's important first to understand the relationship between competition and innovation, as I think. And the second point is that understand the optimum conditions which foster innovation. If we don't understand that, then our design of the rules will end up intervening to an extent where we chill that incentive for innovation. And I'll add one last point, borrowing from Mr. Patnaik's solution, which is access to data. We have to bear in mind that taking away the efforts of someone else can again have a chilling effect on innovation. If someone puts in their hard work, labor, blood, and sweat to collect data and become dominant, but if the government steps in and says that, you need to give access to that data to the new startups, then in some sense, you are appropriating the property that they have created or have amassed.
So I'll stop you there, because what you're saying ties up very well with what Dr. Patnaik and near the end talked about. So I'll go with that to Dr. Sahu. He said that it would be, we could think of ex post, looking at the harm that has been committed, right, or has been caused, and put in heavy fines to act as deterrence, which is, often we use that in law, heavy fines to act as deterrence. Is that a better way to proceed, given what Rahul just ended with? That allow monopoly, make sure that there is no harm being caused. If you can please.
Sorry. So, two things. One is, why did we create regulators? What was the problem with the erstwhile regime of MRTP Act or in command and control regime? The basic purpose of creating a regulator is that you prevent the damage before it happens. If I quote the words of Mr. C.B. Bhabe, this is something like an aircraft is flying at 30,000 feet high. It has developed a snag. You don't have a luxury to come down and repair it. You must continue flying and keep on repairing. And that was the logic which persuaded to convert CCI from a judicial or quasi-judicial body to a regulator. You are not a regulator if you cannot prevent any damage. If you come like a police, like Indian Penal Code, something has happened and you come up and round up the people, go to the executive, the magistrate, that does not work in a market environment. Second is, we have good 10-15 years of experience of implementing this through ex post regulations. Ex post regulation essentially has boiled down to notice that somebody is contravening something and then take an penal action or adjudication. That is what we mean so far. We have not gone beyond that. But how it has worked out? CCI has imposed a penalty of 20,000 crore. We have not been able to realize even 200 crore. yesterday we have seen the data given in parliament that our courts are settled with 5 crore cases. So you can add another million to that 5 crore. You can keep on doing, and after 5 years it will become 10 crore. So where do you go actually? And when you put so much of burden on the so-called complainant, we call it a theoretical informant, because he is a complainant, it's an adversarial process we follow, which is not the right approach. But we put the entire burden on him on that, please you come and substantiate, give evidence, prove the charge, then CCI will act or penalize somebody. So who has the patience? I as a complainant, I don't have patience where it has money to go and fight against a big monopolist who has so much of resources. And that precisely explains why we have less than 100 informations reaching competition authority of an economy where we are saying that our GDP is $3 trillion. How do we find out thousands of contraventions in a security market, which is a component of the entire market? There we have thousands of contraventions have been noticing, and every day you find 20, 30, 40 orders. Why do information stroke complaint does not reach CCI? Why we have less than 100 a year? This only says that this ex post method is not working, and you can't keep on adding. Particularly, see the context I would like to give. You would be noticing about, I think Dr. Patnaik was talking about the top 10 companies. So that has happened everywhere. Today, the life of a company is in danger than ever. The average life of a company, considering everything, competition, innovation, insolvency, everything, is less than 15 years now. And all this is happening because if you talk about ex post, you possibly that you follow a rule of a region approach, which is quite a gray, it's not a black and white you are dealing with. And you are very likely to reach a false negative. That means when you apply a rule of origin, you go more by conduct, more by context, less by conduct. Take the example of abuse of dominance. That says that if you are in a position of strength, what is the position of strength for two reasonable person, rational person, would mean two different things, and you would never be able to agree that this is the position of strength, therefore I can hold him liable. And that is one of the reasons. Forget about the ex post or court system, 5 crore, those things. See? This is one of the reasons that we do not want ex post, because we will not be really able to apprehend, convict a person, because we won't get a clear black and white answer, and possibly we will kill a firm which is having absolutely honest conduct, but I have arrived at a false negative. And that is most dangerous. And if you adopt that approach, if some company is doing good business, they are killed in the process. Howsoever exposed to things you do, you can't get back life. So therefore, I don't think in our experience, exposed to things have worked, but you still need exposed. You can't completely do away, but you should handle, you should prevent probably hundreds, thousands of possible potential contraventions, but you may end up with 5-10 contraventions which you could not prevent because there are some real recalcitrant ones. For them, you need ex post. But ex posto in a market economy, when we have come up with regulators and regulations, does not work.
Okay. In fact, later in the day, there is a paper on exactly rule of reason. So you mentioned that. Rajat. Yes, yes, on ex ante, yes.
Ex ante, ex post. Okay.
This is a panel discussion.
Right.
We're supposed to disagree.
Yes, I sort of disagree with both my previous panelists, but you know, my answer is really a balance of both. You need a balance of both ex ante.
You're running for election?
No, I'm not. I wanted to ask Mr. Patnaik a question which Mr. Sahu has sort of answered. But I think, so this is not, let me be a little more sort of theoretical. The outcomes are not going to be independent of the culture of the place, the society in which we are actually making policy and implementing the rules. And the reason I say that is my experience with a regulator, in which maybe this was 20 years ago, where, you know, when there was auctions for telecom licenses being held, I often heard the argument that there are foreign players who are willing to bid for these licenses and will bid huge amounts for the licenses because India is a must-have market, it was opening up. And that after the license have been given, they will then lobby with the regulator, with the ministry, to get their sort of bids reduced. And actually this is something...
This is what happened.
This is what happened, right? Which means the culture and the societal where you don't... There's a huge deficit of trust. I mean, neither do civil society trust the government, neither does the government trust civil society. So there's this huge trust deficit where you feel that you can lobby and change the rules to your favor, in your favor, by lobbying, by rent seeking, etc. So this is the culture. I don't know whether it's changed or not since then, but this is the culture of the country that we are operating. And we are probably not the only ones that operate in this paradigm. Again, an example of sort of coming to the ex ante and ex post. I think ex ante regulations, we were told when I was, again, the example of telecom, that you need these rules when there is no monopoly. So when there is a monopoly, and in telecom at that time it was considered to be a monopoly, new entrants came in. So you needed to give interconnection. In the digital world, it would translate into interoperability. You need to ensure ex ante that there is interoperability between the digital players. And that's what an ex ante rule will be and should be. Interconnection, often everybody, the new players would not get interconnection with the incumbent would deny it, they would delay it, as you say, justice delayed is justice denied, come after 2 weeks, come after 3 weeks, I've already spent so much on the network, and Airtel is asked, you know, I can't give you interconnection in Nehru Place, you come to Connaught Place. So Airtel has to sort of then put the lease. So these are sort of abuses or ways in which you increase the cost of the new entrant or the new rival that is entering the market. So as far as ex ante rules are concerned, we were told that when there is competition, there is no need for ex ante rules. You can just do ex post, and there should be some broad merger guidelines where you don't ensure that you don't have too much market share, you don't have too much of spectrum, or you don't have too much of the asset which will create an increase in cost to the new entrant. So reducing barriers to entry. So as far as ex ante rules were concerned, that was the limit, and of course protection of intellectual property, as Rahul said. But ex ante rules, like ex post rules, are very difficult to implement for reasons, also the fact that in the digital space...
Why do you say like? Ex ante rules are as difficult to implement as ex post rules. Why do you say as difficult? Yeah.
Well, not as difficult, or at least very difficult. If you think about, you know, making a law or making a rule or regulation of what Mr. Patnaik talked about, subordinate legislation, the sort of dynamism with which the digital space is evolving, the ability to put a rule in place which will stand the test of time or innovation becomes, that's the point I'm making. So that will be challenging given the sort of regulatory mechanism we have in our country, and I'm happy to discuss this later. Also, how do you staff your regulatory body? You had a question in your mail about this. So how to staff the regulator? And I think we need more adequate human capital skills in the regulator, and we have to change the entire incentive structure that exists. On ex post, I really want to sort of emphasize the point that Mr. Sahu made, which is that if you look at the history of anti-competition and sort of competition authorities across the world, fines have never worked. Conduct remedies have not worked, and I don't know whether behavioral remedies will work or not. And
just a minute.
Yeah.
What do you mean by not worked? That means they've done it again?
They've done it again.
And they have not been fined again.
And so if I were to born again, I would love to be born again as a lawyer, and an economist and a lawyer, because what is happening, as Mr. Sahu said, that the monopolist has deep pockets and he will fight tooth and nail to not pay the fine, because not paying the fine is so much more lucrative than just hiring and delaying the process of justice. And that's happened through, I mean, I'm actually studying this topic is from the times of Ford and IBM and Exxon and these conglomerates. Nobody, the cease and desist orders, giving your source code, this has not worked because penalties have not worked. They've paid the penalties and done the same thing again. And this will continue to happen because the penalties are not they don't deter the monopolist from repeating what has happened in the market. And no market in this digital space is contestable. I mean, you show me a market, how is it contestable unless you have these ex ante rules that give the new entrant the ability to use the same information, data? How can it be contestable? I mean, contestability means that I can enter at free cost and challenge the incumbent. Which market is contestable? This is a feature of a textbook in which when AT&T went to court and hired 3 economists, they said that you don't need to break up the monopoly because the market is contestable. How is the telecom market contestable? How is the airline market contestable? I mean, we're told that airline is contestable, the telecom market is contestable. These markets are not at all contestable because no new entrant can come in without facing huge barriers to entry, which are sort of increased by the incumbent. This is the way monopolies work. There is no benign monopoly in the world. And so what I'm saying is you will need a combination of conduct, structural, behavioral, penal remedies to get these monopolists to heal. The other sort of way in which I have seen in India how of social good is often seen as a substitute for abuse of market power. Let me explain.
You'd better, yes.
Yes. I am doing so much for society. I am doing so much for India. I am predicting floods that are going to happen. I am predicting, where the next monsoon, next rainfall, heavy rainfall is going to happen. I'm giving all this information free of cost to the government so that the government can be better prepared to take sort of cognition of these things. So which are forearmed is forewarned is forearmed, etc. So that the government. So I'm doing so much social good. I'm training so many people. I'm doing, well, very good. You should be doing that. But it cannot be as a substitute for abuse of dominance or abuse of market power.
Okay, so we have 3 panelists here. One is a little bit suspicious about ex-ante regulation. The other 2 are very gung-ho about it. So is there any questions from the audience? Yes, please.
Hi, I'm Pranav. I've worked with some of them.
Wait a minute. Is there a mic so that people at the back can hear? Just hold on, please. 1 minute.
Hi, thank you. I am Pranav. I am also a practitioner like Rahul, and I was with CCI earlier.
We are all practitioners here, don't worry.
And the usual disclaimer, the views that I speak does not represent my law firm that I represent. So that has to be. Yeah.
You know, if you hadn't told your law firm, you could have gotten away. Now that you have...
So I agree with Rahul on one aspect that unfortunately we are taking the data aspect as a public good. So someone who has innovated and has created that infrastructure on which other startups in India basically which are not doing more than product differentiation basically, if it's say in the economics term. And then they clamor that they should be given the same luxury and the privilege which the initial innovator has done. So how do we fit in this aspect over here? Because
question to panelists,
yeah, that's the question over here. That how do we fit in simple product differentiation? Who is doing should be given the access to the entire IP infrastructure that an actual innovator has created over here.
I will ask this, direct this question to the pro ex-ante.
So I think you would have seen recently the order of the Delhi High Court Division Bench in the matter of Monsanto, and which overrules the earlier decision and which overrules consequently the CCI decision. So it is essential, there are different aspects here dealt with, but it is essential saying one point that if by patent law, a patentee is entitled to abuse his position, but you can't have a competition law to take away that entitlement. So I think to that extent you have to make compromise. But now your specific question is that somebody has done innovation following a particular route. So once you have done the innovation, that you get the protection. But the route you followed, don't block that route for others. And there are ways to handle it. It is not that we got a digital markets today. Maybe it has become more pervasive. 20 years, 30 years ago, in fact, the theoretically perfect competitive market we have seen, it is not textbook. The most competitive, in fact, you can't have, even theory textbook is not better than what we have on ground is the stock market, where every day, every minute, every second, you have millions of trades orders knocking at the market. And absolutely the complete information symmetry, all that features we talk about in standard textbooks, everything you will find it there. And that was done with the technology only. But we did not find any problem, monopoly issue, innovation issue, because we moved to a technology. Yes, it has created large pools, but that is where what we want to do, how it has been dealt is that if somebody has a position, let's say somebody can deny access to market. National Stock Exchange can say that I will not list you, but that power you do not have. National Stock Exchange can't say that all this data I own. You can't say that. So the sources of abuse has been completely sealed. That means if there is a data, as Patnaik was talking, some metadata, they have a data policy, they have made into 4 categories. How data will be accessed, used, all those are in a formal place. Just because data is generated to one place does not give him any advantage.
But then let me ask you one question. That the examples that you gave in the stock market, and indeed that is true, is essentially to even out the asymmetry of information. So if there are these issues in the digital space, why bring in competition policy? Because those were not parts of competition policy. The SEBI rules and regulations, right, are not part of competition policy. This is just to even out the asymmetry of information. So similarly, if there is something to be done with the data, which clearly is asymmetry of information, right, if that is what the focus is on, why tie it up with competition policy?
I would make 2 distinctions here. Please distinguish between competition law and competition policy, and distinguish between the sectoral law and general law. We do not want to address, and everything cannot be addressed by competition law. Competition law simply says that only 2 things are illegal. Beyond that, there are several competition issues in the system. If you have a indirect tax system as compared to direct tax system, it is non-neutral tax policy, so it is anti-competitive. If you give a differential treatment to private sector entity as compared to public sector entity, this is anti-competitive. But that is not sought to be addressed by the competition law. If at all government wants, they can have a policy. Unfortunately, we do not have it till now. So a larger portion is left outside the competition law to be dealt with, 1. Second, I gave you the example of Monsanto, the yesterday's order, but this has been going on for years about who is looking after competition in a sector. We had an issue recently where I think it went up to Supreme Court, told that no, at initial level, TRI should look at the competition issues there. We have several provisions in the sectoral legislations which gives some kind of foothold to the sectoral regulators like SEBI or those people. They in fact address competition issues at the first instance. Competition Commission actually comes a little later. In fact, that's why there is a explicit provision that when you decide the matter and you find that there is an issue, let's say CCI is trying to address an issue in competition issue in stock market, it is supposed to consult SEBI. And it is also the other way around, SEBI is supposed to consult competition authority. So therefore, there is, when I am bringing the stock market policy, SEBI has addressed that at the first level that it is not anti-competitive and has addressed, because SEBI's ultimate objective is, forgetting about the competition policy and competition law, it also wants there should be competition in the stock market itself. There should be, let's say, many exchanges, many depositories, many merchant bankers, many investors, and that is what the SEBI's objective is. And in fact, the more you rely on competition, the less you have to rely on ex ante or ex post regulation.
Yeah, that's fair. Any other questions?
Can I just respond to that? So,
Yes, of course,
your question, I think, because the difference is that it will have a direct impact on innovation. And the
Yeah, but all of you are skirting that issue. You have to tell me, right, how ex-ante regulation is better for innovation than ex-post regulation. What you are telling me is what harm it can cause. I'm not interested. I know both can cause harm. But what are their impacts on innovation?
So what is it that is giving the incumbent strength to be able to innovate? And an example of that is, as Mr. Patnaik said, it is access to information, access to data, and they have the ability to process that data, which is where that competitive advantage is. These algorithmic, they can prepare these algorithms, they have very good access to programmers to be able to create this product that would be sort of innovative, and whether it meets the test of sort of being new or revolutionary, it will get a patent or not. But if that same information is made available, the new entrants can also do that. They can also make an as good, maybe a better product. The IBM's book, The Elephant Can Dance, showed that maybe innovation can come from the bigger players, but history tells us that innovation actually happens from small and medium enterprises. The other thing that you've almost always seen is there's this paper by Zingales and Raghu and their PhD student in Chicago called Killzone.
It's an old paper.
Old paper, right? So you buy
But it
out
doesn't. You've read the paper.
Yes.
And you agree with it. The conclusion you may agree, but the modeling you agree with.
Model, right?
And there's a question from this side.
Just a minute. You wanted to say something.
Can I just add to this, that, and I'm hesitant about ex-ante doesn't mean that I don't see space for that. We have to be measured in the way we design our ex-ante rules. But how can it hurt? In today's world of digital economy, we need to distinguish the digital products from, or categorize them in two buckets is what I think, is that there are certain types of products or services where the value of that product or service comes only and only when the market is tipped in favor of one or two. I've always struggled with this notion, but imagine a situation where in this city, we had, instead of an Ola and an Uber, 6 different taxi service providers, app-based taxi service providers. Their availability will be focused on narrow, small catchment geographic areas. And if you live like me in Gurgaon and travel to Delhi High Court, then you will have to change cabs twice or thrice. So we have to understand that an ex-ante rule, if it is aimed at curbing the ability of a firm from reaching a certain size and scale, then we are going to stop in tracks the benefit that comes from their offering. And therefore, sorry, I'll just conclude with this, which is that, and that is not to say that we shouldn't have ex-ante rules, because once the market has tipped in favor of 1 and 2, then till the time we witness a Schumpeterian kind of innovation which comes and replaces the incumbents, there will be that entrenched dominance for a considerable period of time. And if there is going to be entrenched dominance for a considerable period of time, then should we use ex post rules, as Mr. Sahu rightly said, that may not necessarily work. If that doesn't work, then there is space for ex ante rules. That space needs to be calibrated, is all I'm saying.
No,
Okay,
as
so
I
I
was
think-
mentioning one thing, that competition issues, 90% of the competition issues are outside Competition Act. Only two provisions which says if these two conduct are illegal. So if you have to handle the 90% of the issue, it has to be only ex ante. There is no possibility of ex post at all.
No, but there, as a moderator, I'm not supposed to disagree with anything that is being said, right? Till the end, when there is no chance of rebuttal. Okay. Now, I want to allow some more questions, but before that, is anybody online? Are people seeing this online? Are there any questions online? No questions as yet. Okay, there was a question on this, huh? There is one on the floor. There is a question too. No, there are many questions on the floor. I've seen hands here also, but I asked for online. Yes, please, go ahead.
So this is basically, if I take the last comment, it's like justifying
The mic, please.
Oh.
It's on.
Yeah? Okay. So if I take the last comment, it's like justifying imposing ex-ante regulation, considering that you know the market, how it has developed. How effective would this regulation be in a market that you don't know how it will develop because you don't know the players, might be different type of players, or the same players acting differently?
Yes, please. We'll take some questions. And you had the same question. Yes?
Many, but I'll limit myself to one, particularly as someone
Thank you.
law and economics. This was a serious concern, right? You said fines and penalties don't work. Fines and penalties are enforcement technology. The question is, if fines and penalties don't work, irrespective of time of when the enforcement happens, then they don't work whether it's ex ante or it's ex post. So then the alternative, I mean, we'll have to look at alternative enforcement technologies as opposed to a
Good point, yes. Now, before these questions are answered or comments are made, one more question. Yes, please. Let's collect the question.
Okay, I'm having some difficulty about some of the comments that are made. One comment.
We are not interested in that.
But I am. And one was contestable markets. And I'll just take exactly the telecom and airline. Geo entered. It is only few years ago. Tata's entered. That was very, very recent, actually. So how do you make statements which run counter to what we have observed? But I want to come to a more serious matter. Penalties don't work. Now, if you mix politics and corruption with penalties, you may be right. But I have known, for instance, FDA imposed a penalty on Glaxo of $10 billion because Glaxo used a drug which for some application for which it was not approved. $10 billion work. But if your penalty is going to be something like a business expense for the company, that will not work. So if you have the political will and the penalties to go with it, or a strong independent judiciary that can implement the penalties.
And a fast-working judiciary.
Even if it's slow, it's $10 billion, it can be more slow. So that's going to work. So please, I just want a little bit of moderation in the commenting and giving examples, because in US it works, but if you say India, if at least you say qualify, a world in which there is corruption. So having heard all of this, I want
you
to
probably didn't hear me well enough.
Sir, let me just pose a question also so you can. Does an ex-ante regulation always exist? Question number one. Question two, how would ex-ante regulation work in conjunction with the politics, where the lobbying is commonplace, where business organizations are also going to try to mold the ex-ante regulation? How will such a world be? And so what does the future hold for India with this question in mind? Thank you.
We'll take it from that end because, because you were first going to question his hearing ability.
So when I started my comments, I said that every law and regulation and enforcement depends on the culture of the place that you're operating in. And so I was not talking about the United States. I was not talking about Europe. I was talking about India specifically, and my experience with India. The examples you give absolutely sort of prove my point. Tata's and the theory of contestable markets believes that any new entrant will be able to challenge an incumbent and be able to undermine or dilute the exercise of abuse of dominance or monopoly power. By any stretch of imagination, Jio, and this was a case that actually played out in India when they were accused of predatory pricing, and the CCI, I don't know whether it was the CCI or TRAI, said that exactly that, which is a new entrant who does not have even 30% market share, does not have significant market power, and therefore cannot be accused of predatory pricing. And therefore Jio was classified as a new entrant, but I think that was not, in at least in spirit, in line with the theory of contestable markets, and neither is sort of Tata contestable. When I make these strong statements, they're not coming from sort of strong in the sense that I have views which has sort of crystallized over the years, and actually seen them at close quarters. When I say penalties don't work, I don't mean to say that don't have penalties. Obviously, you need to have penalties, because there is no other way in which you can discipline an incumbent. How will you discipline a monopoly in a digital space? Because structural remedies, which is the other way that we've tried to do it, breaking up the sort of incumbent, and as Mr. Patnaik said, due to the network effects, the new entrant, the broken up entity will become sort of as big in the future, and then you will be denying what Rahul said, the ability of economies of scope and economies of scale. So I think structural remedies are not sort of a very good solution in this space. It'll have to be sort of penalties, and huge penalties. Now, when you say $10 billion, do you have the implementation machinery within the country to be able to implement that? If you do, by all means do that. And I would agree. Cement companies, 11 crore, I don't know how many of them paid the fine.
11,000
No,
11,000
wait a minute. It's not quite kosher to not be doing something which we should be doing, and therefore trying to correct that by doing something else. If we cannot enforce the fines, we cannot collect it fast, solve that problem. Why are you going to competition policy? Solve that problem. Now make sure that the fines are collected fast enough. Because that's your problem. If this is your problem, why are you trying to find a solution elsewhere?
No. Ex-ante rules are not a solution.
No, I'm saying this example that you're using about money is not being collected from cement companies and all of that. Go out and collect that money.
So there is a regulator who is saying that you have 5 minutes left.
I know, I can see it myself.
One quick.
Now, Dr. Sahu, do you want to say?
Yeah. Actually, I think neither Professor Kathuria or I, we intended to say that A is a substitute of B. It is only a balancing. Ex ante and ex post are not substitutes of each other. But today we have a little more on ex post, less on ex ante. We are saying slightly change the balance. Because we have seen in our culture, we can't change the culture, we can't change the judiciary. So to the extent possible, let's do within the competition law. So how do you handle it? The 20,000 crore imposed and zero realization.
I don't see why the lawyers' problems have to be faced by economists.
Because it is
Rahul,
because...
please, solve your own problem. Work faster.
Sorry, after you.
So no, in case of competition law, the extra reason is, as I told you, rule of origin. Because of this, you cannot say that he is wrong. And that is why the probability of apprehending somebody, convicting is absolutely minimum. So when you can't really find out somebody was guilty before he does that, you stop him. And we have enough experience of...
This is like the Minority Report, by the way,
No.
that movie.
No. See, SEBI, I would say that in the security market, probably we have somewhat a balance of ex ante and ex post. Just to give two numbers, they are not the real reflective of ex ante and ex post, but ex ante I mean that regulations made upfront telling that what you can do and what you cannot do. That runs 20,000 pages today under security laws. Yet, every day you will find 30, 40 ex post orders, adjudication orders. Market is huge, contraventions are huge, but they have a balance of ex ante, and only those which escape ex ante will be caught at ex post. But if you rely mostly on ex post, it will not work. So maintain a balance only. That's all the only suggestion.
Okay, Rahul, please remember that the regulator has already shown me 5 minutes, but the regulator should know that we started at 11:05.
Yes. Just two quick comments on this, on the penalties working or not working and the deterrence effect, and the CCI being unable to collect. And sir, with all due respect, deterrence is also a factor of the quality of the decision making. Taking the example of the cement cartel case, and I know it's a contested position there, the CCI decided after having the chairperson walking out of the meeting, and we lost 4 years in that litigation. The appellate tribunal sent it back to them. So there is a law of the land. If we respect that law of the land, that must apply to both sides. We cannot say that the penalties are not being recovered. Obviously, they will not be recovered till the time the decision is not robust enough. If I think that there are gaps in those decisions, I will exhaust my avenues for appeal. And the answer to that cannot be that penalties don't work. Let's work towards making our decisions so robust that the litigant thinks twice before approaching the appellate courts. We have created in this country a rule of law mechanism where there are 2 layers of appeal. We can't decry the fact that there are 2 layers of appeal and it takes 10 years of time to resolve that. If it takes 10 years of time to get to the appellate process, let's invest more money there than come up with ex ante rules where we really don't know where to draw the line. And I say that again and again. There is perhaps a space for ex ante rules, but we need to be clear where to draw the line. If we draw it too far, we will have an impact on chilling. We will end up killing innovation. We will at least introduce that chilling effect on innovation. And we are a country which can only grow with innovation and nowhere else.
Okay, thank you very much. On that note, I'd like to thank the panelists, but before I let you go, since I'm the moderator, I have a prerogative to bring it to a close in the way I want. So let me just tell you of a story. Long ago, you must have heard from your parents, many people here may not have seen them, some of us have seen them. It used to be very fashionable to tear up your jeans and put patches on them. And because they had to be done by hand, those patches had to be put on by hand because they would be at random places on your trousers or shirts. So it was very labor intensive. And Indians were doing it and exporting. They were getting the jeans from outside, clipping it, snipping it, right, and then putting all these patches. The Americans brought in an NTB. At that time, the MFA was still active, multi-fiber agreement was still active, and therefore developed countries could put non-tariff barriers on clothing imports. So they said that the patch will have to be non-inflammable. It should not catch fire. The jeans could catch fire, but not those patches. So clearly it was a non-tariff barrier. Now, India unfortunately didn't produce those patches. So they had to import it. But the ex-ante regulation was that to import something, you have to have a license. It took 5 years to get that license. In the meantime, the market was taken away by others. Now, this drumbeat for ex-ante regulation reminds me of the 50s and 60s in India, quite frankly, where we have some experts who are deciding how the market is going to evolve and hence putting in guardrails accordingly. They may be right, but I'm terrified at what will happen if they are wrong. There is change happening in India. The market is highly unstable. We have no clue how it will evolve. We have already decided who the players will be. We have already decided what the products would be, what the business models would be, and we are accordingly proceeding. We may be right, but I'm terrified at what will happen should we be wrong. We will exactly where we were in the 50s and 60s. The whole world was watching us. If you look at the documentation, as an economist, I can tell you almost every economist was visiting India to see how it is going to develop. What happened? So that is what I'm worried about. Other than that, ex-ante regulation, ex-post regulation, it's for politics and economics, and your delays in solving problems is going to decide.
I am really scared to get to a situation where, like SEBI, the competition rules are 20,000 pages. Today they are no more than 20 pages, and therefore I'm happy to practice in that area.
Anyway, thank you very much, and to the audience and the panelists. Break now?
Yeah, we'll take a 10-minute break. We're running 5 minutes late, so the break will have to be cut short a bit, and we'll meet exactly after 10 minutes here.
So 12:15.
Yeah. 12:15.
Can I start? Okay. Hi, everyone. This paper is, as they say, fresh off the oven, in the sense that even 1 month ago, I remember posting a LinkedIn message asking people to fill the survey. And today, exactly 1 month later, I'm with my co-author. We are matching on our attire today, by design. I would like Nishant also to intervene as necessary as I present this paper. This paper is about how small firms in India are making use of platforms to expand and also even to survive in some sense and make an entry. The motivation for this paper comes from one of my students who, after his MBA, has decided to start his own firm where he's taking, he's locking horns with some of the big FMCG giants. I was shocked when he came and told me about, I thought I taught him all his life that you do not enter a market which is perfectly competitive. But he told me something very interesting. He knows what he's doing. He has some niche product and he wants to find niche audience. And therefore he would enter, and he was very clear that he was going to prove me wrong. So that gave us some motivation to start understanding how these small players are thinking about competition, how they are thinking about their strategies as they enter the market. So therefore the motivation really comes from this brilliant ad, which is Prachar nahi to Vyapar nahi, no advertisement, no sale in every sense of the word. So in 1995, in the famous book by Tirole on industrial organization, he talks about sunk costs. Sunk costs that come in maybe in the form of advertisement, maybe in the form of overcoming information asymmetry, maybe in the form of setting logistics. Sunk costs become a massive barriers to expansion of firms and entry of firms as well. And I think, therefore, the whole question that becomes important is, how do these small firms manage these sunk costs so that, entry and expansion are possible, right? So continuing on with the motivation, this is a very simple Facebook page that I used to be a part of when I was working at Duke as a visiting faculty, RTP Desi Dads. You wanted to sell anything from India, you advertised on this portal. Therefore, you found your audience. Make sense? The next one really comes from this very simple example that happened on our campus. Somebody ordered a laptop and a garbage got delivered in a laptop bag. All this guy did was, from one of the big e-commerce giants, all this guy did was pick up his phone and call up a couple of his seniors. The matter got resolved in a matter of few minutes. He got a new laptop delivered. So in other words, what is the problem that a new entrant faces? One is discovery of their products. And the second one is, why would I want to order from a new entrant if the established player in the market is very well known? Right? So the incumbent is very, very strong. I mean, that's exactly what I think Spalber talks about. Goldfarb and Tucker in their Journal of Economic Literature paper in 2019 talk about how platforms reduce what they call as replication cost, search cost, finding costs, quite a few of the logistics costs more than anything else that facilitate entry. So the final one I wanted to talk about was logistics cost, how e-commerce, in a famous paper, in a recent paper that came out in Japanese Economic Review, Hayakawa and his co-authors talk about how when, COVID time, when the international trade was taking a nosedive, e-commerce was the one that mitigated the problem to a lot of degree. So therefore, in other words, I think what we are trying to argue here, and we're not saying this, but I think one of the things that I always found interesting when I teach strategy is that economists have long been obsessed with variable costs and sunk costs. Maybe with the emergence of digital markets, there's a new kind of a cost that is coming in, which we would call, for the lack of better word, quasi-variable cost or quasi-sunk cost, whichever way you want to kind of look at it. Make sense? So what are our research questions? Do small firms leverage platforms to locate and serve digital markets? Specifically, two different questions under this. Do you expand your geography within the own country as you get in more digitally savvy? And what are the few strategies, or do you export more? I mean, and do you export more? So these are the two main questions that we look at, and there are a couple of other questions that we look at platform strategies. Or do they look at single platforms or multi-platforms? In technical language, is there single homing that you see all the time, or is there multi-homing? Is there single homing in advertisement? Is there multi-homing in advertisement? Is there single homing in logistics? Is there multi-homing in logistics? That's, I think, the main argument that we would like to answer. And the final other thing that I keep hearing is network effects are barriers to entry, so therefore new platforms should not be coming in. I think the second question, therefore, that we would like to ask in this context would be, do you see new platforms emerging? And if new platforms are emerging, do the small firms actually make use of these new platforms? I mean, is multi-homing among the big giants? Or do you see multi-homing among the small players and the big players as well? So these are the two questions that we all try to answer from the strategy of small firms point of view. A few broad areas of research that we intend to talk about. There's a famous paper that came out by Armstrong and Julian Wright in 2006, where they talk about how in a platform market, in the two-sided platform market, when buyers are different, but sellers are identical. You know, it's a easy assumption to make because sellers are more interested in money. Money is the metric that they're interested in. Buyers are, on the other hand, vary. They want a product, and different buyers want different products. They show something very interesting. You find that buyers multi-home, because of which even the sellers who are identical in nature multi-home in equilibrium. So that seems to be the motivation, the theoretical basis that we want to be looking at. And Cinemo, I believe, in 2021, he has talked about, in a strategy journal, I believe, Academy of Management Studies, he talks a lot about how each platform brings unique capabilities to the market out there for the small players. One of the things that he says, and here is where I think there's a bit of a controversy if I were to go by the previous panel, he says that platforms are indeed unique, and that provides them a contestable feature. That's the reason why he believes that platform markets are contestable. Each of them offers unique services. Similarly, I think we can talk a lot about entry into platform markets. Zhu and ENCT, Strategic Management Journal 2011, talk a lot about the strength of network effects and the ability of an entrant to realize a lot of these network effects to succeed. The same guys, I didn't cite it here, but in 2021 paper in Harvard Business Review, argue that network effects may actually be a little oversold. There are conditions under which network effects actually work as entry barriers, and conditions under which network effects do not work as entry barriers. But the long and short of it seems to be that, if I look at other papers as well, the success of an entrepreneur really depends on the size of the network that they're entering in, and the ability of other entrepreneurs to coordinate with each other in order to figure out an entry point. In other words, it's not just the indirect network effects that matter for small players to survive. It seems even direct network effects seem to matter for small players to actually survive in this market. The other thing which is interesting that we would like to address is that in emerging markets, we've discussed a lot in the previous panel also on how the emerging markets are a little different than the established market, the developed markets, if you will. We are talking a lot about how platforms mitigate problems that are typical to emerging economies. Adverse selection, information asymmetry, legal systems. I mean, there's another famous paper that came out by Palepu and Khanna, Strategic Management Journal 2007, I believe, and the Shankar and Narang paper in Strategic Entrepreneurship Journal, which talk about the role of platforms being significantly different in the emerging economies when compared to established markets that would facilitate entry significantly. So this is not a paper about entry, by the way. This is a paper about expansion into new markets. So therefore, in some sense, you can look at it as an entry into new markets. So let's talk about theoretical framework. I teach in a management school. So therefore, for me, theory means boxes and arrows. So therefore, that's what I'm going to present. You have a logistics cost, discovery costs, and information asymmetry. The platform, these are all the sunk costs of entry is what we're calling them. And then you have platforms which are buttressed by direct and indirect network effects. And that will allow you to ease into new markets. So that's the basic framework with which we are going to work as far as our empirical strategy is concerned. So what are the few hypotheses that we have in mind? The first hypothesis is that small firms advertise more on digital platforms than conventional platforms. Why? Advertising on digital platforms is more targeted. Advertising on digital platforms is cheaper than conventional platforms. So therefore, that's the first hypothesis that we are looking at. Small firms that rely on digital platforms have broader market outreach. That's our second hypothesis. A corollary of our second hypothesis is they sell in wider geographical markets, including exports. They export. They tend to export a little more, the firms that are more digitally savvy. The final hypothesis is that small firms, both for advertisement, market discovery, as well as for logistics, use multiple platforms for their survival, right? So what's the data that we actually use? I love this cartoon, actually. This is my go-to for every empirical methodology that I've ever, empirical paper that I've worked on. Figure out the results, then look for right data. It's always fun, right? But nonetheless, this is a mixed methods paper. It started out as a couple of student projects where my students went and interviewed around 10, 12 startups in depth. Then, as I said at the beginning of the talk, Nishant, I and Danny put together a questionnaire which we have sent to close to 4.5 lakh people, carpet bombed them. Yeah. So I'll let Nishant talk a little bit about that part.
Let me just, since I was closest to actually getting the data to, as the cartoon says, prove the answers that we already had. But no, so what we did is the following, right? So as Vishy said, the objective of the empirical exercise is actually to understand small firm strategies which relate to platforms, and then make some inferences from that. So what we've done is, in the absence of any standardized data sets that actually ask this information, we took the population of all firms registered in India in the last 7 years. So that's the MCA. So that's the Ministry of Corporate Affairs data set. So every month, starting January 2016 to December 2022, we have the data for all the firms that registered, including the sector of operation. And then what we did is we obviously cleaned the data up. We required emails. They weren't always present, so we've selected the data that had emails. And then we have focused on sectors which are, for lack of a better word, consumer-facing, which means that we did not include in the sample any intermediate goods firms, right? So if you sell machinery, for example, to automobiles, you are not in the sample. And the reason for that is because if you look at the conceptual background that Vishy just sketched out, platforms can help convert some fixed costs into variable costs, but if you need to establish a car plant to sell cars, that they can't help you with, right? So you don't expect change to happen there. And after we selected those sectors, we have about 4.5 lakh odd emails that we sent out survey invites to over a period of 2 months. And this is a very simple online survey because everything that we read suggested that if the survey is more than 3 minutes, you won't get any responses. So it's a very short survey, and you'll see what the survey asked in a bit. But we did manage to get about 1,450 odd responses, which is a 0.3% response rate, which is not bad for online surveys. So when I did that, I realized how difficult it actually is for these firms to enter, because they're doing exactly the same thing that we are trying to do, which is to get people interested in clicking on something that they don't really want to do. And that's difficult. I think it's a very difficult exercise to do if you are. And so, which means that, just to make the point about the paper, that this is when we are targeting, right? Because email, this is the most targeting advertisement you could do. It is going exactly to the people that we wanted. And this is what happened after that. So imagine if you were spray painting, right? This would be disastrous. So you would actually have huge cost of discovery
And therefore, practical experience suggests that digital advertising does help reduce costs of reaching people, right? It's just the basic way of how the internet works. It is a recorded two-way communication. There is no wonder it changes things where you want to reach people, right? So very quickly about the survey respondents. So the good thing is, on the left, this figure, the left panel, is the geographic distribution of all firms registered, right? So that's the population. So Maharashtra is black because 20% of all firms registered in India are registered in Maharashtra. That's where they form. That's not us doing anything. The right-hand side panel is the breakup of the responses we received. Now, obviously, this is not in our control, but thankfully, we've actually managed to get a representative geographic survey, geographic response rate. So the correlation between the two series is about 91%. This is true even at the district level, right? So if we break down this data at the district level, we get the same sort of correlation. So,
Which
sorry?
one?
Oh, that I think
This
is
one?
some state in or some district in I don't know where that is actually. I'm not sure.
Possibly. Yeah. So, I mean, this is just basically the number registered versus number responded.
So there is some district somewhere in the middle of nowhere which is actually registering a lot of firms. Now, why that is happening again is maybe Jamtara. But the important thing is that even people from Jamtara responded to a survey. That's what matters for me. What is not important, Jamtara registering firm is not important, but people responding from Jamtara is, and we got those responses.
So we're not telling a Bombay, Hyderabad, or a Bangalore story.
Yeah.
We're telling a.
So it's geographically representative. Next slide.
Yeah.
And the other information we do have from the MC, it's a very sketchy, it's a very scant database. You don't have to give up too much information when you register, but you do obviously have to give a year of formation. And so the survey is, the graph overlays the two distributions, one with age and the other one of the respondents and one of the population. Again, these distributions overlap fairly well. Our respondents tend to be younger, which is not surprising because...
Sorry, just clarification. How do responses received be more than companies registered?
Oh, no, that's a distribution
That's
within that. It's the population within the proportion within that distribution.
Yeah.
So those are overlaid distributions.
Or like I saw the 20%.
Yeah.
That's right.
Yeah.
That's right. Yeah.
Yeah.
So, and so they are very close even in the metric, so that median is presented, the mean age is presented there, which is very close. And then finally, we just talk about, next slide, can we go?
You said 1438. Why do you have 820 there?
Oh, that is because we did not, a lot of people did not respond using the same emails that it was sent to, and so we have matched using emails as well as names and other characteristics, so we were able to match about 820. So this is drawn from the sample of 820, but this is just to show that the samples are the same. And
Landing on your survey website.
sorry?
Are they landing on your
Yeah.
survey website using email?
And so just very quickly before Vishy walks us through the results, we are some very, so these are some very basic characteristics of the sample. Even our survey is very tight. Size, of course, so given that these are all young firms, it is not surprising that they are all small. 59% of our sample report having a revenue of less than 1 crore, that's 10 million rupees. And 82% of the sample is actually less than 5 crores or 50 million rupees. Surprisingly, and we did check this in various ways, a lot of these small firms actually do export. But that is a lot to do with the fact that if you see the first row in that table, which gives up the gives the sector of operation, these are firms called direct to consumer, which are a product of the digital world, right? Because direct to consumer firms are essentially manufacturers selling directly to consumers, bypassing the entire supply chain, which is essentially what e-commerce does. The reason why e-commerce is considered efficient is because it reduces the number of elements in the supply chain. So a lot of firms, of course, sell outside because they're entirely digital.
One small thing, I mean, I think, it's also misnomer to call it small firms. Maybe we should call it as virus firms or something like that. It's not even micro.
Yeah, these are really small firms. So this is the we are not following any standard definition of small or large. This is how I'm defining small or large. An average firm sells in around 1.5 regions out of 4. So we just quickly divided north, south, east, west. We asked them where they have positive sales, and that's the statistic. That's important. We ask these questions about export and market reach because remember, one of the hypotheses that we want to test is that compared to similar firms, and this is not pushing a causal claim, but compared to similar firms, do firms which are online sell to a larger geography?
Yeah.
Again, the idea being that that is something that platforms allow you to do. It is all self-reported because it's an online survey.
Yeah.
And finally, obviously, so we just, the digital presence of firms, 76% advertise digitally. Not all firms responded, by the way. Therefore, we have reported the sample which responded. So which means out of 1335, 76% advertise. About 100 firms did not respond to this question.
Yeah.
Similarly, about 81.26 of 1206 have a website, and then about half the firms out of about 1200 sell online. This is not, I don't think this is representative of all firms in India, but this is, there is going to be some selection bias in the responses because one, unless you are digitally savvy and you check your emails very often, you are not going to even receive the survey, let alone respond to it. And obviously, if you are not comfortable operating digitally, again, you are less likely to respond to the survey. So there is some bias, but we have about 1/4 of the sample, which is not present in any of the digital forms. So we do have some comparators to people who are selling online. We have some small firms who don't within the same sector as well, right? So there's some comparison that we can do, which we will draw on later.
Yeah. So just to, thanks Nishant, quickly to present the results that we actually have. Small firms advertise more digitally, right? The difference, this is how the firms advertise digitally. This is the conventional advertisement that you actually see. The difference is increasing as or decreasing as the firm size keeps increasing. I mean, the small firms, so for the large firms, they have several avenues to advertise. But for small firms, it seems that digital is the only way for them to actually advertise, in every sense of the word. So that's, I think, something interesting that we found. The way discovery is happening. हो गया यार.
ठीक है.
You're supposed to be tech savvy, you should turn it on.
I actually figured out that people who work on technology are the least technology savvy people ever. My greatest nightmare was when Microsoft changed from 2014 to 2019 and my computer got updated without my knowledge. But anyway, right? So this is the difference that we wanted to quickly highlight. The next thing that we wanted to talk about is how the various kinds of advertisement are happening. You can notice essentially that other than pamphlets, everything else follows a pattern. Pamphlets are cheap. So that's the reason why you don't necessarily see much of a pattern. But the problem with pamphlets is that they're geographically very, very, very restrictive in every sense of the word. So therefore, if you want to be expansive in the way you would probably advertise, again, for the small firms, it seems that the conventional advertisement is not working out, other than pamphlets, obviously. So let me...
So small, medium, large is how?
So 10 lakhs, sorry.
Up to 1, between 1 and 10, and more than 10.
10.
So we've combined
Million.
Million rupees, yes.
So the interesting point is you use multiple ways to advertise. Obviously, these numbers don't add to 100 because there's a lot of overlap in the kind of advertisement that they do. 1,077 firms have responded to this particular question. Social media turns out to be the most popular form of advertising across.
So within digital, what
Sorry? So these are the 4 drivers that we've asked them questions over, and this is based on the pilot that we did with some of my old students in alumni network who have done their own startups. We've tested with them, and we came up with these 4 metrics. And roughly, social media seems to be predominantly the kind of an advertisement that firms do. Median number of channels that a firm uses is 2, and the mean is roughly 2.25. Larger firms, of course, operate on multiple channels when compared to small firms. Small firms restrict themselves to 1 or 2 and all that stuff. But that's the crucial part. They have some avenue to advertise, right? Firms, multi-home even on social media. So one interesting thing is that Facebook, Instagram are predominantly high in terms of their usage. Of course, their network size is very large, so therefore, presumably they are advertising. But the other interesting thing that we notice is that others is not insignificant either. It's picking up. Again, I think if I were to repeat this survey a few days later, my hunch, and this is coming from informal, from the qualitative survey also we did, is that the others will pick up as well, 4.83. There are websites like MX Takatak that we keep hearing, which are providing, which are gaining a lot of traction in terms of social media advertisement.
Just one thing before we leave this is, I think what we find, and it explicitly came out when we talked to people, obviously not as explicit when we did the survey, is that we often talk about, especially when regulators and economists talk about advertising, we talk about, almost always talk about advertising as two-sided markets, which they are. However, a lot of the smaller firms actually, and that is what is called pushing content organically, which essentially means that you are not, you are using your creativity to basically promote your content, and the content contains information about what you sell, rather than explicitly relying on advertising. And therefore, direct network effects. So you need direct network effects because that's how you're reaching people. It's essentially a digital version of word of mouth, right? So direct network effects are a digital version of word of mouth, which is not as often pointed out. Again, it's because it's usually not quantified, so it's monetized, and therefore, since it's not monetized, market sizes don't exist, but people do use them, and it's free. Right?
Yeah.
So, or if it is, even if it's not free, you have to pay a creative person to create something for you. So you pay that person rather than the platform to promote yourself, right? So that is something that we found as well. And maybe that's the reason why social media, including especially the ones with direct network effects, are so predominant in terms of advertising.
So an interesting idea is that it is not just about Facebook that competes with Yahoo, Yahoo competes with LinkedIn. It is about, even you see multi-homing among Facebook and the little players in the market out there. And I think, to me, that's a very interesting idea about contestability of these markets in some sense. Again, I'd be a little careful in making a generalizable statement about contestability at this stage, given the evidence that we have. But there is an evidence that there is entry into the platform markets as well. That's where I would leave it at. The next thing is multi-homing for sales. This is where I think we looked at. Website sales are very important. It seems that website sales, their own website sales, are competing heavily with the platform sales. Firms obviously want to do website sales because they don't have to pay anything to the platforms. But the problem is you need to drive traffic to your website at the end of the day. That's where the social media part of it seems to be coming out in a significant way. We've had people tell us, both for selling food stuff, people who sell saris, multiple people that we've spoken to, they're telling us how they would use a combination of all these. The median number of platforms, once again, is 1, and the mean number of platforms that a small firm uses is 2. Right? So that's, I think, something. The entry of Myntra and Meesho, a surprising thing is that social media also people do sell, apparently. So to me, that's a very interesting idea. Our argument that there seems to be a cross-linkage across various platforms. So platforms are not just substitutes, they may be complementors to each other as well. That's something that our survey is trying to tell us. So therefore, just to quickly conclude, on the first part of the results, small firms are reaching larger audience digitally and are selling more digitally. The next question we ask is, do small firms which are digitally present serve larger geographies? So again, we're not attributing any causation out here. We're just saying that we see some correlation, and that's what we try to look for here. The interesting thing is we run a simple regression where your y variable is 0, 1, 2, 3, 4, discrete variable. And we're trying to look at whether a firm having digital advertisement capabilities, e-commerce capabilities, has any advantage in serving greater number of geographies. So the interesting idea is that the firms that advertise digitally sell in 0.23 regions more than the firms that don't advertise digitally. The other argument is people who are online savvy with e-commerce sell in 0.3 regions more than the firms that are not the one. The cross, the interaction effect is even more significant. The firms that do both have greater geographical reach than the firms that don't do either. That seems to be the conclusion that we could come up with. Yeah, all the standard errors, everything, standard econometric ideas of robust standard errors and everything else. The other thing is that we also tried to look.
So digitally present, by that you meant digitally selling?
Digitally selling or digitally advertising?
So we look at them separately and then interact.
So
if I'm digitally advertising but not digitally selling,
yeah, so that also.
say no to digital selling.
Yes.
Yeah.
So essentially the last regression, the last column divides the data into 4 parts. So the first 2 columns divided into 2 parts. If you advertise digitally or you don't advertise digitally, and we're basically comparing them with, of course, some control variables. So that's why a regression makes sense. The last 2 columns basically divide the data into 4 parts because that's the interaction. So interaction of 2 dummy variables is essentially going to divide the data into 4 parts. And the group in that 4 that is actually driving the results are the companies which are selling digitally as well as advertising digitally. So the results are coming from there. Yeah. So that's where the results are coming from.
So what is exactly the Y here? How do you define it?
So 1, 2, 3, 4.
It's a number of...
India is divided into 4 regions, east, west, north, south. And we're basically asking, are they selling a little more in other regions than they're located at? Again, that's... Y is a quantitative, is a discrete variable which takes value 1, 2, 3 or 4 depending on number of regions that you operate within east, west, north and south of India. Could we be a bit...
So it is possible for me to be in region 1.
Yeah.
But sell
only in region 2. Yes.
Yeah.
But I will still be counted as 1.
Yes, you'll still be counted as 1. So, and we have examples of such kind of firms from the qualitative interviews that we have done. You are located in Bombay, but you're selling exclusively abroad, or you're selling in Gujarat. I mean, we have examples of that as well. Yeah. Move on. Yeah, you had a question.
Yeah, what are those different categories of Y?
So one would mean that you're selling only in one of the east, west, north, south.
Okay,
2 would mean you're selling in 2 of east, west, north, south, and so on and so forth. Yeah, there's order.
Ordered variable,
there's order.
yes. Ordered variable increasing in the... So it's a numeric significance. So there is no it's not categorical, sorry. It's not a categorical variable.
It's not a categorical variable. It's not a categorical variable.
Sorry, we should have said that.
Yeah, so we've tried alternative specifications, by the way, as far as regression is concerned, multinomial logits and all that stuff. There's nothing much that's changing. Stick to linear, simple. It doesn't matter.
No.
That's what we're trying to say.
This isn't, but the results don't change.
Yeah, I mean, point estimates obviously change, but...
1, 2, 3, 4 is 4 directions and exports. That are not
Exports is 0,
we'll
1.
come to next. Yeah. In the next slide, we present the export part of it. Here, now, Y is a pure categorical variable. In exports. It's either you export or you don't export, 1, 0. And we again do the same regression, and we find that it's not significant in the conventional metrics, but it is, advertising digitally is significant at 11%. Sure, I mean, we are pushing it. I agree.
Significance is not there, but is there some sort of summary statistics that suggests
Yes, yes, that's, you want
So,
to talk?
Okay, so sorry, the results are in line. If you are okay with an 11% significance, and the results are in line with what we presented earlier, they have more geographic reach. And one of the reasons why we don't have significance is because we have about 255 firms in all that export. The moment we start cutting them
Digitally
into 4
versus-
parts and have turnover, we don't have enough firms in each cell, right? So therefore you won't, I mean, this is a shameful regression to do if you are serious about it. So regressions, however, but you are right. So the reason we present the regression is because if I just draw a simple summary table, you will find that firms which advertise and sell, and this is true, by the way, for all sizes of firms and all sectors. So I can control for sector and turnover. The previous result is very significant. So even within a sector, firms which are digitally present sell to more regions, right? Within the same size and same sector, they sell more. So again, it's not causal, but I think there could be unobservables that drive these results. But the correlation is quite significant. And so the same thing is true for exports. And before I think we're on the last slide after this anyway. So before we, I think the idea is that if you just dwell a little bit on the nature of the endogeneity, which Vishy and I did, why the results are not causal, see, both exports and the decision to be digitally present are strategies.
Yeah.
However, the decision to export is what in development literature is called an outcome. It's not in your control. It's a start. You want to export, but you may not be able to. However, you can be digitally present. That is entirely in your control. So the endogeneity, at least to me, is not that strong, but we are not pushing it.
No,
I
we're not
think there is
pushing
no
definitely
endogeneity, but
won't
we don't want to
get
push
into
it.
the causality too much. I think we are very upfront in saying that this is picking up correlations and nothing more than that. Yeah, so quickly, I think again to summarize, I understand, Subhashish, your comment about this part, we are pushing it, but nevertheless, small firms are, small firms are at least... Yes, fair enough. Yeah, so what are the implications of our results? From the managerial standpoint, well, small firms that use digital platforms are doing greater business. And there may be a possibility of greater increase because the sunk costs are going down. That's another paper that we are working on, and hopefully we should have some more results on that at a later stage where platforms encourage a lot of entry. I mean, as an IO economist, I know one of the vexed questions is empirically modeling entry. A lot of structural models and innovations have come out on this. I think we'd like to see whether or not entry is happening or not, but that's for a later date to discuss. One of the things that our qualitative survey also shows is that the data that these large platforms collect are helping small firms to reduce their costs significantly. Why are we saying this? It's not as if the data is limited to these guys. There seems to be genuine data sharing about the, for the small firms that use the platform. That seems to be the USP that the larger firms seem to be coming up with, that are allowing them to do better analytics, that are allowing them to target their customers a little better. So that seems to be something that our survey was picking up. What are the policy implications? Well, I think the previous panel discussion probably is good enough. Ex-ante regulation in some sense is great, but you need to know your market for you to be able to talk about ex-ante regulation. The story of platform competition, according to me, is not a partial equilibrium story. It seems to be a more general equilibrium story because there are repercussions of regulations of platforms on the small firms. And I think that story is being neglected in the policy discussions that I have been a part of or have spoken at, and that seems to be something which is very, very, very important. Direct network effects seem to play a role in small firm decision making, and that's something that we could say fairly categorically. And therefore, policies that regulate platforms need to consider the repercussions they have in the downstream sector. So that's where I think I'm going to stop talking. Thank you for not pointing out the...
We did, but we ignored it. Sorry, we have a discussant who's been waiting patiently. Pisha, can we put Geeta on, please?
Yeah. Thank you very much.
Is she on?
Geeta, are you there?
Oh, that is me. That's not her. We know Nishant is there. We are putting her on now.
Geeta?
Oh, there she is.
We are not able to hear you.
You can't hear me?
Yeah, we can. Okay.
Okay. And where is Vishwanath Pingale with all his statistical work? Come on the screen.
So we'll go there.
We'll go there to our seats.
But if you go there, whom do I address?
Sorry? Who address?
Hey, it's all empty, so it's...
You can address me. I should have stayed here. I'm sorry.
Yeah, send Subhashish there then.
Yes.
I'm incognito.
Now can you see
Ha,
us?
ha, ha.
Okay.
Ah. Okay, they've told me 5 minutes, but there's a lot that I think will have to be taken up because it's a very ambitious project. First and foremost, let me congratulate the 3 authors about how it is a good beginning for a new form of investigation into the area of the role that small firms play on platform markets and whether the small firms are such that they're able to allow for a competitive edge for platforms. I think I will look at some of these things much more and less on the case of having calculated all the regressions and arrived at different connections. Because personally, whatever you have stated in your paper raises a line of arguments and analysis, each one which should be taken up. It is not something that you can easily forget it and say, we just look at small firms and then go about. Because even in terms of defining what a small firm is, I know somewhere you mentioned you're not looking at investments at all. So you should be able to define what a small firm is. And you're looking at the firm in relation to what? If you're looking at it in terms in relation to tax policy, it doesn't matter. But if you're looking at it in terms of the platform and a two-sided market, even a small firm can have a tremendous impact. And this is what is happening in the merger cases. You see, therefore, it's the sort of advantage that can be based upon. Now, having stated this, and also the fact that I think it's the beginning of a lot of research, which is what I find that is so good about this paper. It's an initiating paper. I think to take up a few things and quickly, it's claimed that there are about 14.5 million startups. No one knows who these startups are and for what, but then the government of India puts those figures out and they're always startups. And that these startups are both on the platform and they're also on their own website. And some of them do very well on their own websites, especially, as you said, those selling saris. Not only those selling saris, those selling MTR powders. These are the ones you prefer to stay with the website itself than go onto a platform. But there must be certain advantages for a startup to go onto a platform. I can understand perhaps the advantages that a platform may get from getting a startup, but I don't know the other way. Now, if I take this proposition and then start looking at a two-sided market, what you all have done is try to bring the two-sided by looking at only one side. You have looked at the side of the seller and the question of the advertising that the seller comes in with. But the question of the other side is what the consumer wants has been completely ignored. It is true that in a platform market, the most important thing that is required is that of trying to get network economies. You have to populate both sides enough. Otherwise, the platform just cannot grow. That's one of the most important things that one knows and learned about platforms that are taking place. So when you get into this whole thing, the research questions that are going to be asked, and I think you have brought up upfront only on the question of small firms help to convert high fixed costs into quasi-variable costs, and therefore they reduce their cost possible. There's a certain lack of a respect of which firms you're talking about. So pay more attention to your Form 4. The slide 4 is where you had raised those two important questions. Those are the two important research questions that you will have to develop considerably. And in these two important questions that come up, the thing that has to be looked at is, do platforms provide the legitimacy for new entrants? See, if a startup wants to go onto a platform, does it provide any kind of legitimacy? The second thing that one has to look up is, if startups or platforms and they also have their own website, why do they choose a platform and not stay on with their own website? So when you are talking about it, there's a little bit of an overlap between competition between platforms, which you say is healthy because you have about two of them competing each other, then with the question of the startups competing with each other to decide on which platform they intend to go, even when there is multi-homing. So the entire concept of competitive constraints on a two-sided market gets changed. Two players is enough to call it a competitive constraint. And this, I think, is very important because the competition law somehow has not been able to keep in touch with these developments. May I ask you to go back to the case the order that had recently been given out by the Competition Commission about a year back, before Mittal, before the new chairman had joined in and before the other ones had come in, where they had talked in how do they attract startups into a platform. And one of the cases that was put up is that the agreement between the startup and the platform was a very biased agreement. The agreement was against the startup and in favor of the platform, and therefore this resulted in what is known as price discrimination. But can you have price discrimination in a platform? In terms of competition law, this concept is still being debated, and I don't know if they've arrived at any situation regarding this dynamics of price discrimination. Now, having stated this, now small firms to platforms depend on the goods and services that the platform produces. If there is no such question, then you need to do specific research to find out which firm goes to what. I do not know. I think it was IDF which had a very good seminar or a conference about a year back when these issues were taken up. And you had got some very interesting startups from Bangalore, and they were trying to make out the point of where do they want to proceed and how they go into it. But for heaven's sake, don't forget that you have to be very careful in terms of what the competition law has at present and what it is trying to look at. Now, having stated this, the important point, and I am now trying to close it quickly, is that while you are concentrating so much on the side of advertising, on the side of small firms coming onto a platform, which is one side of the two-sided market, what is it that attracts consumers, which is the other side of the market? The two somehow have to get interrelated. And if you don't get this, the statistical analysis you've done tends to be very puerile. I really didn't get anything much out of those statistical analysis, except to say that both of you are very good in statistics. But in terms of an analysis that has to be done, this is a subject that is extremely important. And I would like you to look at it, is what are the sort of competitive constraints that can be given to the platform markets. And invariably, the platform markets are the big five, which is the GIFAM. In this, I would like to further mention a point which Vishwanath had talked about. You see, Reliance also started its own platform market. It is online. It's trying to sell everything as online commerce and getting as many companies as possible. And there's been this case of Reliance with that other Indian firm, and there have been fights on it going on. And Myntra has also been involved in it. But the point in this that is important to look at is that all platforms are interlinked. Please let me tell you that there are shares of Amazon and Reliance just as much as there are shares of Reliance in Amazon, if Amazon can be called the platform market. So this interlinkages between shares. You are looking at a geographical market and a geographical expanse. And then if the competition law has to come in, how do they look at it? Therefore, that one case that has been done, and there has been a lot of arguments based on this case order that was recently, and they talked about agreements and agreements being unfair. It depends on who gains and who is unfair, and whether the consumers have gained or not gained, and who is the consumer and what is the benefit that's getting. Now, I have given you very generalized arguments for the simple reason that it requires a lot of research. But having started in the startup, which is an excellent thing to start your next project in your work, please get funding and please start looking at the different lines I have raised and then examine further. And you're going to get a terrific study because I don't think the other countries have done it. Whatever I've read, either of EU or of what the FTC is doing, they are now still sort of stuck up in their own little thing about it's an European firm, it's an American firm, and this is what we're looking at. Perhaps Brazil might have something interesting to offer, but even there, I have my doubts. And in terms of research work, you're on the right path. That's all that I have to say. Thank you.
Geeta, are you giving us any money?
Yeah, I will. I'll ask
Oh,
Subhash.
okay. Good. Well, that's the best discussant I've ever had in a paper. But thanks, thanks Geeta, and thanks everybody else. So we'll, we are anyway 5 minutes late, so we'll move on to the next talk. We can always take questions. We are here. So thanks. Thank you very much.
Okay then, bye. See you all next time. अच्छा बोला
Shall I? Okay. So in the next 30 minutes, I'll present a model which tries to predict how the markets will develop or evolve, which is already very difficult to do, especially if we consider ex-ante regulation. We do it focusing on collusive bidding. We basically revisit collusive bidding. However, considering this time, a new type of
Why don't you put it on? Because
okay, I can do that.
Since you're moving around.
Yeah. We basically revisit collusive bidding. However, in the presence of a new type of player, which wasn't there in the more classical economic models, which is a non-producing entity. So basically, we consider a technological innovation which is owned by a non-producing entity, and how that might affect competition and welfare in this market for ideas or innovations. Now, why this is important? You want me to shut this down? Both of them? Yeah. Why this is important, or an important exercise that we do, is because usually the competition policy advocates tend to object collusive bidding to buy new innovations on the grounds, on the inefficiencies of collusion, right? Collusion increases prices, reduces quantity, and therefore does not maximize welfare. However, this is findings based on more general markets. When we consider kind of markets for ideas, which they are kind of unstable, and we have much innovation going on, and we have new type of players, then these findings might not necessarily be evident. And we show basically the opposite, that collusive bidding might be better for the firms as well as for the society. There is two important features that allow us to find this, to claim these results. First, that we consider the new technology being held by a non-producing entity, and second, that this technology has a destructive feature, which we discussed before. So a destructive feature in the sense that it can either impair the value of a technology that is already used by incumbents, or even make it obsolete if it's a breakthrough, which we'll call a drastic innovation. These cases we will consider in the slides to come. Now, another reason why this exercise is important is because it can explain what we actually observe, that some new entities are formed out there that basically only buy patents and then license or sell them to the members of these consortiums or cartel of groups, but they don't really actually engage in production. And this is something that we see a lot in the US market, in the EU market, and we think that our analysis or our prediction might be able to explain why we observe such entities around and why such entities grow to be that powerful in the market. Now, we have basically two examples that show well this space that we're focusing on, that we discussed. The first one is this Rockstar Consortium in 2011. Basically, it was an entity, a group of big tech companies formed from Apple, Microsoft, BlackBerry, Sony, that was fighting or competing against another cartel of big tech companies, which was Google, Intel, and other companies there, for the acquisition of 6,000 patents, which were Nortel Networks patent in 2011 following its bankruptcy. Basically, the Rockstar Consortium was successful in acquiring those patents at a price of 4 or 5 billion, 4.5 billion, I think. But what they did is that immediately after that, they sold 4,000 patents. And they kept only the 2,000 patents that their members were interested in having. And they basically licensed these patents to the existing cartel members, and then this entity ceased to operate in its current form. It's not out there any longer. So it was just a kind of special vehicle purpose entity that bought the patents, redistributed them among the cartel members, and then ceased to operate. And another such entity that is still an ongoing concern is the ACT Trust, which does exactly the same thing. And we call this kind of strategy a catch and release patent strategy. Basically, you aim for the patents you want, you acquire them, you license to the group of members, and that's the only thing you do. So such entities are quite common in the US market. Now, what if we analyze how firms compete in these kind of markets where we have these entities present, where we have these non-producing entities that own the new technology? What will happen then? Will we see that collusive in still harming welfare, or something, or do we see different results in that? Now, if this is how the transactions in these markets take place, we observe, or we find two distortions in the markets. The first one is that basically we allow monopolies, firms that earn monopoly rents because they own these technologies, these patents, in exchange for, of course, early disclosure, right? Because they could go in secret and keep disclose the information for these technologies in a later date. So this is the first distortion, the allowance of monopoly profits or monopolies. And the second one is this ex ante regulation, or the per se legal doctrine that we discussed before. Basically, allowing firms to form cartel or to exchange information before the bidding process, it's kind of anti-competitive by nature, right? So it should be per se illegal. So if we would have an ex ante regulation in place, would not allow these companies or these entities to form. However, by doing that, we will see that maybe this market would not develop at all. Hence, we analyze this effect of ex ante regulation in the market for ideas. and how this will distort competition and welfare. Another interesting thing that we observe is that basically in the US and the EU, the competition authorities have allowed such practices more recently. So they allow the exchange of information among patent buyers before the bidding process. So basically they apply the rule of reason, which I'll come to that in a second. We have a statement from the antitrust division in the US which says that if this cartel of buyers buy patents that are essential for some technologies like standard patents, then they should be judged based on the rule of reason rather than on the ex-ante regulation or the per se doctrine. And we see more of this. Now, I don't think I have to define the per se regulation or the rule of reason, but basically the per se regulation is when a practice is strictly categorically anti-competitive without really analyzing the effects of that. And the rule of reason is basically exactly the opposite, which you have to balance the anti-competitive effects with the pro-competitive effects, and then take a judgment whether this practice should be allowed or not. Now, this Rockstar Consortium, which was basically a cartel of these big firms, was allowed in the court of law in the US based on the doctrine of the rule of reason. And the main argument for that, that upon time, was that basically we applied the rule of reason because we protect downstream users from the threat of holdup, of patent holdup problems. What is a patent holdup? A patent holdup problem, you may be aware of it, is basically when a patent holder claims a legal suit against an incumbent at the moment that the incumbent is most vulnerable, that he has implemented a new technology. At that stage, he cannot really change course, right? So he is very weak at that point, and at that point, these patent holders come and file a lawsuit for infringement. Therefore, they are sometimes called patent trolls. Now, we agree that maybe applying the rule of reason in such cases helps to prevent this holdup problem a little bit. Why? Because you do not prevent the incumbent from producing till a verdict is reached. And then if the verdict is reached and you find infringement, you'll find a settlement or a compensation for that, which is better than just shutting down production till we resolve the issue, as we would have with the per se regulation, for example. However, we don't see how applying the rule of reason increases surplus or creates value. They don't kind of find these kind of arguments. Why do you apply the rule of reason? We don't see value generation there. And what we provide, we think that this is a lack of theoretical work in this field. And we do find that actually, by applying the rule of reason, there is surplus generated from allowing collusive bidding in these cases when a group of incumbents aim to buy patents or new technologies from non-producing entities. And I'll try to convince you on that in a while. So basically, to the main point, what we ask is why authorities do not challenge collusive bidding for patents, and why the courts employ the rule of reason to analyze the competition effects arising from collusive behavior among buyers of innovation. We extend this question to cover also drastic innovations. By drastic innovation, I mean a breakthrough, which once it's implemented by one firm, will drive all the other firms that use existing technology out of the market. So it will create basically a monopoly. And also, in the case when we have a potential entrant that has entry costs, how this game will unfold in these situations. Now, what we think we contribute in the literature, and would be interesting even for practitioners, is that first of all, we provide this theoretical foundation to analyze collusive bidding, which we show that reduces patent acquisition prices and actually facilitates the implementation of new technologies. Otherwise, these new technologies might not even be implemented, especially if we have ex-ante regulation on that. We won't see these technologies, we will not reap the fruits or the benefits of these technologies. Yes?
What was the rationale of these companies behind forming this, consortium? When they, exchange to, law or, media or,
So basically, why do they form these entities, you are asking? Their official stance, that I don't know, but I can tell you that it's in their benefit to form this, because they share the patent price cost, of course, and they share the technology, or they diffuse the technology among themselves. And it appears that in such a way, because they benefit from the lower price that they buy this patent, they don't have to pay for an additional premium so that another company doesn't get it. It increases their profit, and this happens to also increase consumers' surplus, which makes all happy in a sense. So this is the first thing. The second, we show that incumbent firms, if they behave in such a way that they collude with each other, they form cartels, they can always outbid an entrant when the technology destroys value in their existing assets. Why? An argument for that would be because they have to protect their existing assets. They have what to lose. The entrant doesn't have what to lose. And we show that, we prove that later on. More importantly, we find that collusive bidding increases consumer surplus as well as improves social welfare, which, if you go into the classical economical models or exercises, this would be controversial. Basically, collusion always harms. So this is the main contribution, and now I'll briefly go through the problem statement. I'll focus first on the destructive feature. So we want to introduce the destructive feature in our model, because otherwise we won't see these effects of collusive bidding. Now, if we have a setting with a number of firms, an arbitrary number of firms, and at least more than two, and if I define the profit of these firms with P, with index I0 means P for each firm I1 to N, and the 0 means that we are in the status quo. No new technology has been implemented. Nothing has happened. Now consider that the new technology comes in. However, it's owned by a non-producing entity, which is not part of the market. Then, if one of these firms I implements this new technology, the winning firm in an open auction, in a bidding process, then the profit of this firm, I think I have a pointer here. Oh, yeah. So the profit of this firm, PI, for I1 means that this firm and only this firm implements or owns this new technology. So in the bidding process, we have only one firm, firm I, that implements this new technology. Of course, we should also derive the profit of the other firms that still compete in the market. However, they keep competing using the existing technology or the status quo technology. So this would be firm J, and the profit of firm J when firm I has implemented the new technology, we denote by this pi J I1 in parentheses. Now, let the new technology have this destructive feature, which brings us to our first assumption that if this is the status quo profit, that everyone is earning in the beginning, because remember, to start with, we assume identical firms, so everyone earns the same. Then the firm who implements this technology, of course, can reduce its cost. So if we say that the new technology is a cost-reducing technology, it means that it reduces the unit production cost of each firm, then the profit of this firm would increase, that implement the new technology. However, this has a destructive effect on the firms that do not use the new technology. Hence, they will be worse off than a status quo case. They earn a little bit less. So if I can explain it in a more simple way, yes? The second inequality, you mean this?
Yeah.
Yes.
Because patent was already there in the market, and these guys were not implementing that technology, and they were maintaining the profit fight.
Yes.
So now somebody is keeping that patent idle, or he's that person the next company who is going to sell this patent is already using that patent because of some financial viability which is going to sell.
Yeah, so we start a bidding process, and this guy here is the winning one, then he implements this new patent.
Why second is inequity not a strict inequity?
why this is not equal to P naught. Because if I implement a new technology, it will have a cost on you not implementing it. Because remember, the technology is destructive. So it impairs the value of the incumbents with the existing technology. It affects you. So your profits go down. Yeah, but no one is implementing it. A non-producing entity owns it. So the moment that I implement it, it harms you not to implement it. So you will earn less. Therefore, you'll be more aggressive in bidding against me to get this new technology. So if you don't do anything, of course, you'll earn less than the status quo profit. So this is by assumption, but basically this is what we observe in high technology industries, right? So if I have to explain it in a more simplified way, if this is the status quo profit that everyone is earning in the beginning, and I implement the new technology, and only me implements this new technology, I'll earn a little bit more. However, my another competitor in the market would earn less because he would see the value of its existing technology deteriorate, go down. So I may call this distance A. The difference in profits there A. And if this difference in profits here is B, then we'll immediately know that the difference in profits between the firm that has implemented the new technology, when all the other firms keep operating in the market, and the firms that have not implemented the new technology but operate in the market with the existing technologies, this difference is A plus B, which means that it's a little bit more than the standalone value of the patent. It has this premium embedded, which basically, in order for me to win this bidding process, I have to pay a premium to prevent the others from getting the technology. So if this is the case, then, and we start the bidding process, let's suppose that the patent price we denote F for any positive F. So this was gross profits that I was talking before. If we incorporate the price of the cost of acquiring the patent, then we can also introduce the net profit, the capital pi I, for firm I implementing this new technology, which would be basically the profit we talked before, minus the cost of acquiring the patent. In this case, if any bid is F lower than this difference in cost between the firms with the new technology and the firms with existing technology, then, of course, there is another second better F that another guy will be willing to pay to get this new technology, up to the point that this inequality becomes an equality, up to the point that we pay the equilibrium patent price, in which case the equilibrium patent price would be the difference between the profits of these firms in the market. Now, if this A plus B, it will be A plus B in this case. No, if the patent price, the equilibrium patent price is A plus B, and if we substitute this expression in the first net profit expression that we had in the beginning for the firm that has implemented the new technology, it's just simple substitution, we'll see that the firm that gets the technology, it's not better off than the firm that doesn't have the technology. They both basically lose. Why? Because they pay more for the value of the patent, so that no one else gets it. So we'll see that all market participants, at least the incumbents they are producing, I'm not talking about the non-producing entity, they will be worse off. Now, they will be worse off in comparison to the status quo, right? They will end up earning less than what they used to earn before the bidding process started. Yes? Yes.
So the moment you relax that assumption, this will not be met.
Yes. But isn't the assumption realistic enough for you? What happens with a new technology comes up in the market nowadays? Don't it affect the existing ones?
Fair enough. I'm simply trying to understand that the concern that we should have at this point in time, as you said,
yeah,
is that even after the bidding process, the concern that we should have, as you mentioned, the primary concern is all firms are worse off after the competitive process.
Yes.
All that I'm trying to make sure is that this concern is driven by the core assumption that you have made.
Yeah.
The moment I relax that assumption, we might not be in the position that we are in, which means that we may not always find this kind of outcomes that we're dealing with.
Yes. If the technology is not destructive, then we might not have this discussion, you're correct. So, but we consider technologies that have an impact on existing technologies. So new technologies that have an impact on the existing ones. So if we start from that assumption, then we'll see that each firm will be worse off, in which case, what is the better thing to do? Don't start a bidding process, right? So keep earning the status quo profit instead of earning less. However, this is not also a good outcome. Why? Because we have a cost-reducing technology, a new technology, which might be good. However, we don't implement it. It will be unused. It will be unimplemented. Now, we show that through collusive bidding, if firms have this choice to bid collectively to acquire this new technology, they may, in fact, be better off and make also consumers better off by implementing the new technology. So if I go to our setup, I will assume a simple Kuno oligopolistic setup, if you recall a little bit of Kuno. So it's one of the competition models that we use in industrial organization to model firm interaction. I will come to that.
Okay.
We'll basically analyze only consumer and welfare surplus from here on.
Okay.
So basically what will happen, consumer surplus will go up, but I have to show it, right? Yeah. So in this simple setup that we have, we also use a very common linear demand function there, inverse price. So the price equals to A minus BQ. A, B are industry parameters, constants, and Q is the quantity of the product in the market. P is the price of the product. We also assume that each firm, so we start with identical firms, right? So each firm has the same unit production cost, C. Now let the new non-drastic technology reduce this unit production cost C from C to C prime. So we have a reduction in cost, C minus C prime, basically. This brings us to our second assumption, because we want to start with a technology that basically allows all markets to produce, all firms to produce in a market. So we consider a non-drastic technology. A non-drastic technology means that the moment one firm or a number of firms implements the new technology, it doesn't throw the other markets that produce with existing technology out of the market. This assumption holds for one firm implementing the new technology. We'll adjust this assumption later on to include the case when more than one firm implement the new technology. Now, given our assumptions, and if we denote the production for each firm as QI node in the status quo in the initial stage of the game, we can easily determine the equilibrium outcomes, which is the quantity and the profit of these firms in equilibrium. And definitely, we can also say that because firms are identical to start with, everybody produces that much and earns this quantity. Now, the moment we have determined these outputs, of course, we can determine the aggregate output of the market and the aggregate price in the market, or the price of the product in the market. Now, why we do all this is because I want to do a welfare analysis. So we have to now, given that we have all the equilibrium outcomes, we can compute consumer surplus, producer surplus, and total surplus, or social welfare. Basically, consumer surplus is n squared over 2b with this expression in brackets, a minus c over n plus 1, which is the number of firms plus 1. Producer surplus is the sum of all the profits of the producing entities in the market. And when we sum up them, we have the social welfare. Now, we repeat the same basic analysis for the case when the technology has been implemented. I start with the general case when n firms have implemented the technology. In the paper, we start with one firm implementing technology, and then we show the more general case. However, these results are more general, and when one firm implements the technology in the market, it's just a special case of the results that I'm going to show here. Now, if we do the same thing and we assume that each cartel member pays a fraction of the patent price, which was capital F in the beginning, if you remember, so he pays F, then we will have m firms implementing the new technology and n minus m firms producing with existing technology. We adjust the assumption for drastic innovations. So we still consider non-drastic innovations. And we can, the same way, determine the equilibrium outcomes of this game. We don't have to go through that, but this is important. We can now determine the social welfare when M firms have implemented the new technology. Given that we have the social welfare of the status quo and the social welfare with M firms have implemented the new technology, we can compare and see what is the effect, what are the welfare effects. And this brings us to our proposition, the only proposition of the paper, that collusive bidding increases consumer surplus and welfare surplus. Therefore, it exists a patent price, F, which is determined through negotiation, of course, from the patent holder and the firms, that would lead us, would generate additional surplus. How we distribute this surplus in between the patent holder and the firms is not the focus of our paper. It's important that we have shown that collusive bidding has increased, has generated surplus in the market. This you can immediately see from the, so another thing that you can see, if you go back here in the consumer surplus, you see that it's increasing in M, which means it's increasing in the number of firms implementing the new technology. So consumer surplus increases the more firms implement the new technology, the more diffusion of technology we have. And if you take the extreme case of this M being N, which means collusive bidding for all the firms in the market, it's even higher. So we prove this, basically, that consumer surplus increases, welfare increases, when the number of firms in the market implements the new technology, and therefore, we suggest that competition authorities should not challenge collusive bidding, which results in outcomes where more firms use patented, cost-efficient technologies. So this is the case when all the firms collude in the market, and we still show the same, that the profit of each firm, I, when all the firms have implemented the new technology, is more than the status quo profit, which means that every firm becomes better off. Welfare also increases. How they distribute this profit, this surplus is another thing. Now, so basically we have made our point that collusive bidding does not harm or does not prevent the maximization of profit in the market and welfare for a non-drastic technology when all firms produce in the market. Now let me just very briefly go through the case where the technology is drastic, which means that the firm that implements this new technology will drive out all the other firms in the market that produce with existing technology. So we have a monopoly, basically. Yes? It's only one.
There was one where you mentioned that regulatory authorities should not question collusive bidding practices.
Yes?
Right. Results and outcome. So this is just a clarification then, because that is a peculiar nature of the non-drastic innovation being cost reducing. If it's any other kind, then we might not see the price reduction that leads to the consumer welfare increase.
Could be. If it's quality, it improves quality, we can still see the same effect.
Anything that increases the value will give you the same result.
Yeah.
The important thing is that the new technology not being used when somebody is using it must harm those who are not using it.
Yeah. So in the case of the drastic technology, this becomes even more important. So we of course adjust the assumption for drastic innovation, which is the opposite of assumption 2, as you can see. Now, of course, the firms that don't use this drastic technology, they earn 0. They are out of the market. The only winning firm that gets the successful bid to implement this new technology, we can easily derive its profit, which is the monopoly profit. Now, if we have the monopoly profit, of course, we can determine the consumer surplus, in this case, of the monopolist. And we know that this is given by this expression here. Now, if we compare this expression here, 1 over 2b, which multiplies a minus the new cost, the cost efficient actually, the C prime, over 2 in square, we'll see that this might be higher or lower than the consumer surplus in the status quo case, in the initial phase. So you cannot really claim now that collusive bid, implementing the new technology improves consumer surplus. It might be the case that it reduces it. So differently from the case of the non-drastic technological innovation, one firm with a new drastic technology may reduce and may harm. may reduce consumer surplus. However, if these firms were to collude, all of them, in acquire this technology, then we can clearly show that the consumer surplus in this case is more than the status quo, than the consumer surplus in the status quo. Therefore, one firm having this monopoly power is not good. However, all of them together bidding for this new technology and implementing it, as long as this technology is cost efficient and harms or reduces the value of the existing technology in the market, then it improves consumer surplus. Now, this suggests that collusive bidding leads to even higher levels of consumer surplus when the technological innovation is drastic, and also implies another thing, that we prevent the existence of a strong monopoly, which has the rights on a drastic technology. So collusive bidding can be used as a tool from regulators to basically prevent the emergence of such strong monopolies in the market. Now, I will go very quickly because I don't have the time, although I think I studied a bit later. Did you consider that? Okay. So I consider the case, we also consider the case of a potential entrant. Obviously, this entrant pays a cost I to enter this market, these barriers that we were talking before. Now, obviously, this entrant cannot enter with the existing technology in the market, right? Because it would have been already there. So there is not enough profit there to be shared among the existing firms and an entrant. Hence, the only way this new guy enters the market is through if he successfully bids and acquires and implements the new technology. In that case, he can enter the market. In that case, what he basically gets is the profit with the new technology that we can determine. Remember, all these kind of expressions here are very redundant if we just substitute for n. If we make n equal to 1, n equal to m, or before if we made m equal to 0, we'll go in the status quo case. It's easily simplified. So this is the profit that this entrant would get. These revenues minus the entry cost minus the cost to acquire the patent. Hence, the willingness of this guy to enter the market obviously should be higher, or should be maximum. The maximum willingness is this one. It's this expression. The revenues minus the cost of entry. He is not willing to pay more to get this new patent because we have to assume that he makes a non-negative profit, right? He cannot enter and lose. Now, if we compare this, so we know the profit of this new guy in the market. We can also determine the profit of the existing firms in the market, the incumbents. So the incumbents in the market now earn 1 over b, and this expression in brackets, notice that this expression in brackets is exactly the same as we had before. However, it's m plus 2 now. So the number of firms in the market has increased. These guys earn even less now because a new guy has entered the market. So if we can compare with the status quo profit before, you see that this is m plus 2, this is m plus 1. So their profit shrinks even more. What does that mean? This means that an incumbent now is willing to pay the patent price that he was paying before, which was a standalone value of the patent, plus the premium that no one else gets this patent so he doesn't harm me, plus an additional premium to prevent the entrant from getting this patent because the number of firms in the market increases and therefore the pie shrinks, reduces. And if we compare these willingnesses of the incumbent and of the entrant, we can definitely state that a potential entrant cannot basically outbid an incumbent for this new technology. Why? Because the entrant does not face the risk of having existing asset decreasing in value when losing the auction. Whether the incumbents, they have to protect their own existing assets. So to conclude, I know I have 1 minute, but I'll take one more, please. So the key takeaways from the study, I think, are that collusive bidding among incumbents on a patent which has this destructive feature, held by a non-producing entity, a patent holder, can generate value that competitive bidding among incumbents cannot generate. This is something new because in the classical models, we do not have non-producing entities. We only have incumbents competing with each other. They invest in R&D and come up with new innovations, or they inherited new innovations. At the moment that we introduce a non-producing entity and a patent that has a destructive effect on the existing ones, we see that collusive bidding may indeed be a better solution. Second, collusive bidding increases consumer surplus, particularly when the technological innovation is drastic, and improves welfare. This means that collusive bidding may be used to prevent the emergence of monopolies. with the sole ownership of drastic technological innovations, which it's very high market power, which is not good. And of course, a potential entrant can never outbid an incumbent, since we said that the entrant has nothing to lose if he doesn't get, but the incumbents lose more if an entrant joins their market. So I think I'm done with this, and thank you. Yes.
So this is a very interesting exercise.
I'll leave it
and
here.
now I have two important questions, and I know Subhasida will agree with me. How is it different from R&D, cooperation, literature? Because there also we have, depending on say vast expenditure of R&D, we often allow that let the R&D be jointly undertaken, and then later on the competition takes place. Okay, so it has very close proximity with respect to that literature, which is in terms of the R&D being done jointly. Here it is essentially that some outsider does the R&D, but then you are bidding collusively. So essentially the same sense of cooperation is there, okay, in terms of getting the technology and used by everybody. Okay, so that helps the consumer surplus and all that. Second point is that what happens when a subset of firms they bid, what is happening to the bid price? Because not the same amount of bid price will be there when a subset of firms collude and bid. Okay?
A subset of?
Firms collude and bid. The bid price will not be same as when they are all independently bidding. Okay? So in terms of that, the NP, the non-practicing entity which has developed the technology will be having maybe less amount, right? Okay? So in terms... Okay, okay, okay.
That's the understanding that is not there in the first question that you asked.
Right.
Because in the first question, there is no transfer taking place. All of us are gaining, all of us are investing.
Right.
Here, there is this transfer taking place because that's the difference between market of ideas and any other thing, right? In the market for ideas, idea once produced has zero cost.
Exactly.
So not using it is a disaster.
Right.
And whatever the person gets is a pure transfer.
Right.
There is no value being generated.
Right.
That's what that is. But you won't get this result in the joint R&D.
Exactly. And the second, the last point actually, if not the second one. So the last point is that this is once the technology is in existence. Okay. Now, if I factor that in, and I am an innovator, I am going to be an NP. Okay. Then, in anticipation of that, how the market will unfold, will that also affect my innovation incentive?
Well, of course it will.
Yes.
Of course it will. But
And
that's not the economist's concern. Economist is not interested in what is it called?
incentive for innovation is economist concerns.
Wait a minute. I'm not interested in how the surplus is distributed. I'm only interested in the surplus being generated. Right? The question to ask is not whether I will not have an incentive if I don't get paid well enough. That's obvious, right? You pay me 10 million rupees every month to become a bus driver, I will leave everything and become a bus driver. So that's not being questioned at all. The thing that is being questioned is whether we give an incentive to have more innovation than is necessary. So that question that you're asking, obvious answer is of course yes, but that's not the right question. Because everybody knows if you pay me to do something which is very bad, I will do it. So that's not the question. The question is, if I do that, if there is any cost to society, is the value I'm generating more than that cost? Right? So the question you're asking is that if there is competitive bidding, in which case, by the way, what he did not emphasize enough is that if there is competitive bidding, the technology won't get sold. And that's the first result. And hence we have to allow. So if you say that only reduce the incentive, you won't be able to sell it. So this is actually increasing it.
Okay.
Thank
Can
you.
I ask a clarifying question? Why will technology be not sold? What was the driving that?
Oh, well, you see, the original idea for this came to us because we were looking at, there was something that was set up, which were called patent exchanges, which is a brilliant idea, innovative idea, right? That if I have a patent, I put it on the exchange and people can, go through, because the patent is always published, so you have all information, and you see, sometimes you want to see what its uses are, so you see other companies bidding, you get information there also, what this patent can be used for and all of that, and hence it will be a good market, right? A platform for bringing buyers and sellers together. And 2 of these were set up with a lot of fanfare and all failed. Right? So we asked ourselves, why did it fail? Actually, platforms will fail simply because I can now observe whether you are bidding. So let's go to a simple example of A plus B, right? So two of us together are making 100 each. We are 2 Kuno duopolists, we are making 100 each. Now this new technology comes up by which you will make 200 and I will make 70. Right? So I will fall from 100 to 70, you will jump from 100 to 200. Now clearly this is good. There is no arguing about it because the total is 270. And because it is being sold at 270, we know that under most demand curves, consumer surplus is also going up. Right? But the firm who is not using the technology is moving from 100 to 70. So what will be the price of this technology? You are increasing, right? It will all, so we will both come down to 70. And we both know that. So if you sell it on an exchange, I know whether you're bidding or not. The moment I see your bid, I will immediately bid. And then both of us know we will lose. So we'll just wait. And that is what is happening with all the Nautil patents. And then we came to this. And that is how we realized what was going on. Right?
So it's incentive compatible for the...
Because now there's only one thing to check. That suppose Nishant is the one who has this technology. And you and I are looking at each other, right? You quietly call him up on a burner phone and tell him that you are willing to buy it because you see, no, if we go on this open market, none of us will buy, right? So I'm willing to pay you this much. He says, okay, I'll keep it a secret. Then he's immediately going to call me up and say, Krishna has offered this. So this is also, in that sense, sustainable, this waiting and watching policy, rather than doing anything. So that's the first part of the argument, that this market will not work. And hence the default is that the status quo prevails.
So from there it is a genuine improvement.
Genuine improvement. And hence that incentive doesn't matter because it's just a transfer. So for our calculation it doesn't matter. And the difference is between 0 or something positive for the innovator.
How would this change?
I answered because my name was
How would this change if we allowed the F to change? If the NPE can foresee this, that there is going to be competitive or collusive bidding, whatever it is, amongst those firms, I'm not going to charge a fixed price. I'm going to have a higher bargaining power here, perhaps. It is an auction, so would he not?
But how can the non-producing entity cannot really influence there, right? As long as the asset is there to be auctioned, it's we that decide.
No, I think her question is that will the bid price in collusion, that was my question also, that will it change depending on how many firms are actually in the collusion?
Oh yes, definitely.
Yes.
And then how? That's the question. So when the F increases, do I see that F is going down?
Yes. You saw that we have 2 Fs, basically. I don't know if I didn't emphasize
F
well.
by M and
Exactly.
F by.
So you also have F depending on the number of users of the technology. The more they are, the lower they pay.
But no, there are 2 questions here. If the number of colluders is more, the price paid by each firm goes down.
Goes down.
Whether the second question, so both have to be.
Okay. Thank you.
Sure, sure.
Okay.
Okay, so firstly, I would like to thank IDF for giving me the opportunity to present my recent work. So what this paper is trying to analyze is the effect of overlapping ownership, which I will explain in a minute, on its effect on investment composition. So this paper firstly brings together these two, distinct yet very timely and active literatures. So the first is the literature on overlapping ownership. Now, this is an umbrella term that actually encompasses these two kinds of ownerships. So one is called a cross ownership, which means that firms directly own stakes in their rivals. Okay, so for example, Mahindra owns 20% stake in the Tatas and vice versa. Okay, uh, the other a bit detailed form or a bit indirect form of ownership is what is called common ownership, where you have these large institutional investors, say Berkshire Hathaway or BlackRock, Vanguard, who are owning stakes, significant stakes in multiple firms within the same industry. And there has been a recent, or there is a very recent debate on this issue that commonly owned firms are causing anti-competitive effects. And this discussion is mainly in the US and Europe. So I will very briefly talk about some data in the US and then, touch upon how it can have implications in India. So firstly, there was a rapid rise of commonly owned firms within any given industry in the US. Okay, so a bit of history that in the US, institutional investment, and what I mean by institutional investment are these large private equity players owning significant stakes in firms. Okay, so this institutional investment grew as a proportion of aggregate ownership of equities from about 6.1% in the 1950s to about 20 to 30% in the 1980s, and then up to about 65% in 2010. Okay, so as a consequence, the US public firms within the same industry under this common ownership of private equity firms also grew dramatically from about 10% in the 1980s to about 60% in 2010. Okay, now if this ownership, okay, although it was in the hands of private equity firms, was sufficiently diversified, it wouldn't have been a cause of concern. But the problem is that it is concentrated mainly in the hands of the big three, which is BlackRock, Vanguard, and State Street. And as we see in the bar graph here, their influence has been increasing over time. Okay, so on the x-axis, we see the time in years incremented at roughly about 8 to 9 years. And on the y-axis is the average, the shareholding in the average S&P 500 firm. Okay, so what I mean is that, say BlackRock, okay, the amount it's owning in each S&P 500 firm, you just take an average. Okay, so that's what I mean by shareholding in the average S&P 500 firm. And in the year 2000, the big three combined, okay, used to own about 6% in the average S&P 500 firm. Within a span of 8 years, this doubled to about 12%, and then again doubled to about, roughly doubled to about, 21, 22% in 2017. So we see this exponential rise in common ownership, and that is a cause of concern if these owners are able to influence the decision making of firms. Okay, so the mechanism is that these owners are trying to control the incentives of the managers and thereby affect the decision making of the firms at the level of investment and output. Okay, so this investment is mainly R&D investment, which would translate into innovation. So that's how this paper is, fitting the theme of the conference. But when we are looking at the anti-competitive effects, we are not only interested in the investment and its effect on innovation, but also output and thereby the prices. So in this literature on common ownership, these two main effects have been identified. Okay, so the first is that because of common ownership, okay, these firms are internalizing the negative externality they're imposing on each other, because the managers are now trying to behave in the interest of the owners, and thereby they are accounting for the profits of their rival firms. And by internalizing these negative externalities, it's going to put a upward pressure on the prices or downward pressure on the output. On the other hand, there are positive externalities due to spillovers. Okay, so what I mean by spillovers is that it's hypothesized that in any industry, okay, when firms are, or whatever knowledge the firms have, it is benefiting other firms, in some, through some knowledge transfers, etc. This may not be explicit, but that's the base assumption that depending on the industry, there might be some inherent spillovers within across the rivals in that industry. Okay, and due to these spillovers, you have positive externalities from investing in innovation. Okay, and then the main question is that, which of these two effects dominate? If the positive externality dominates, then common ownership may increase innovation and thereby increase output. If the positive externality fails to dominate, then it would mostly have anti-competitive effects, which would decrease output and thereby increase prices. Now, the prior work has exclusively focused on the impact of common ownership on the quantity of investment. Okay, and they haven't looked at the composition of investment. Now, in reality, we know that firms are multi-product, and that's how this paper connects with the multi-product literature, and that firms have to actually weigh the opportunity cost of investing in one market against the other. Okay, so this trade-off that the firms are making is not captured in the existing literature that exclusively looks at the volume of investment. Now, why is looking at composition of investment important? Mainly because it determines the direction of innovation in society. So, I mean, as a society, do we want to reduce the cost of, say, cancer drugs or maybe some cosmetic drugs? Okay, so there could be some ethical or moral implications behind that, but largely the direction of innovation is of first degree importance for the development of a society. The second is, and which is specific to this literature, is that my paper challenges the idea that these spillovers, which I mentioned over here, generate benefit. Okay, so let me briefly explain my model, okay, and we'll get into the details of the model later on. So in my model, I have an oligopoly, okay, which is that you have a finite number of firms, and each of the firm has market power to some extent. That is, by changing its quantity or price, it can influence the price of the market. Okay, so I have an oligopoly where each firm operates in exactly two markets. Okay, so let's say the markets are A and B. These two markets are assumed to be independent in the sense that if the price falls in one market or the demand, or there is a demand shock in the other market, it's not going to affect the other market. Now, the key distinction between these two markets is the curvature of the inverse demand curve. Okay, that's what my results are capturing, and that's something we'll discuss later, what this curvature means and why is it producing the difference in results. Thirdly, the choices that the firms are making in this model is that they're choosing cost-reducing investment and output. Okay, so in the model, they're doing it simultaneously, but if you like sequential and you think that's more applicable, it's okay, because the results also extend to that case. And as these markets are independent, okay, there has to be some dependency created between them. And this dependency is created at the level of cost. Okay, so firms are allocating a limited budget across these two markets. Okay, what this assumption is capturing is that the firms have to weigh the opportunity cost of investing in one market relative to the other. Okay, so this is the key ideas at the level of the markets in the model and at the level of the firms. Now, let's get down to discussing at the level of the ownership. So this overlapping ownership, which I explained could either be common ownership or cross ownership, is exogenous. That is, we are not accounting for the incentives of these owners to invest or how much they would want to invest. We are just assuming that they have exogenously invested some amount in these firms. And as a consequence, what happens is that the firm managers are putting some weights on the profits of the rival firms. Which means that, say, firm I is putting a weight, say, of 20%, 30% on the rival firm while maximizing its profit. Now, the next assumption is just to keep the model very symmetric. And therefore, I assume that this common ownership, this overlapping ownership is industry-wide, which is that suppose you have N firms in the market, then the ownership is between all the N firms and not a group of those N firms, or a smaller group of those N firms. And also that the overlapping ownership is symmetric, which is that the amount or the profit weight one firm is putting on the other is the same between all firms. Okay, so these assumptions are made mainly to simplify the analysis, but even if that's changed, it doesn't change the economic intuition behind the model. And lastly, I don't assume any spillovers in the baseline model. Okay, in an extension, I include spillovers and it doesn't really change the result. And that's the main reason why I don't have it in the baseline. Okay, so let me explain you my main result. Okay, so in the model, I'm assuming conditions for the existence of a symmetric interior equilibrium. Okay, so when I'm explaining the model, I won't get into those conditions because that's not the point. What I show is that as overlapping ownership increases, the output, okay, in both markets always tends to decrease. Okay, so the unilateral effect of increasing this overlapping ownership is that it always puts a downward pressure on output. However, when it comes to the investment, it can have a effect depending on the market. Okay, so it increases investment in the market with the relatively higher curvature of the inverse demand function. Okay, and that's why, at the beginning, I said that these two markets are differentiated based on the curvature of the inverse demand. Okay. Now, this is the effect of overlapping ownership, as I said, in isolation. Now, the question is that what is the equilibrium effect on output? Okay, so the what that means is that in isolation, overlapping ownership tends to decrease output, whereas increase in investment tends to increase output. Okay, and in the less elastic market, the investment always decreases and hence the output decreases. Okay, so in the less elastic market, both the investment and the output decreases. However, in the more elastic market, the investment actually increases. However, although the investment increases, the output still decreases. That is, the effect that investment has on increasing output is not sufficient to offset the effect overlapping ownership has on decreasing output. So as a consequence, the consumer surplus decreases in both the markets, A and B, and the producer surplus, which is the profit of the firms, increases in both these markets. And introducing spillovers, which, I'll explain what I exactly mean in the model, it doesn't affect the conclusion. So, so the basic idea of the paper is that the effect that overlapping ownership has on output and investment. Okay, so these are the two things that we are usually interested in competition policy. In the less elastic market, both output and investment decreases, whereas in the more elastic market, investment increases, but output at equilibrium always decreases. Okay. Now, let me place this paper in the literature. And, before talking about where it's placed, let me briefly touch upon the common ownership debate. So this debate actually started with this paper by Azar and co-authors in 2018, although there was some papers before that, but it's their paper that actually triggered this debate. And yeah, I mean, their paper showed that common ownership increases prices in the airline market. But then, there have been other papers that also show that, it's been having anti-competitive effects in the financial, banking, and the manufacturing sectors too. Now, more recent papers have actually shown that the prices decrease in some markets. And this has produced a bit of an ambiguity as to whether this has pro-competitive or anti-competitive effects. Now, to explain this phenomenon, okay, so there is this seminal paper by Vives and Lopez, which is published in JPE, the Journal of Political Economy, that consider a model where firms are choosing output and investment. I mean, just the way I do it in my model. And their main results are the following. Okay, they all depend on the spillovers, okay, which is the knowledge transfers occurring within an industry between firms. And this extent of spillovers is independent of the ownership. I mean, they're just spillovers that's occurring within the industry. So what they show is that for low levels of spillovers, the investment and output decreases. For mid levels of spillover, the investment increases. Okay, so this is the positive externality I explained previously because of spillover. So that is causing the investment to increase. But this increase in investment is not sufficient to offset the decrease in output from common ownership, and therefore the aggregate output decreases. And then for high levels of spillover, this investment seems to be sufficiently high that it also increases output. So the point of this paper is that, okay, I mean, we shouldn't be labeling common ownership as, anti-competitive. There could be some cases which is high levels of spillovers where common ownership may actually increase output and thereby decrease prices. So if you see in my paper, the results are significantly different. I get the second result that Vives and Lopez have. So firstly, all my results are without spillovers. They are based on the difference between two markets. And the result that investment increases but output decreases is something I get for the higher or more elastic markets, whereas the case where investment and output decreases is something I get for the low elastic markets. And I actually don't get the result that the output can ever increase. So the, the, the main idea is that, okay, I mean, the paper that Vives and Lopez have seems to apply exclusively to single product firms, but in reality, we have multi-product firms, and therefore this benefit of common ownership doesn't seem to actually, pop up at all. So yeah, so this is the main idea behind my paper and where it fits into the literature. Now, let me just briefly mention about how this can be applied to the Indian markets. So firstly, Indian markets are quite different from the American one, at least in terms of common ownership, because we have, say, the foreign investors like, Bain Capital, KKR and Company, etc. Then we have the domestic private equity players like Kotak, ICICI Bank, etc. And then the public ones also like LIC. I mean, LIC seems to be owning significant stakes in many companies. So, and there is no systematic study in India on how, this ownership is spanning across companies, whether it's concentrated in the hands of a few, because suppose it's diversified, then it's not a particular a cause of concern, but if it is just in the hands of a few, then it is. So that's an exercise which is quite intense, and possibly it needs to be done. But actually my paper is acting as an argument for why this should be done. I mean, there is a debate, and there seems to be mostly an anti-competitive effect because of these, common ownership. And therefore, the Competition Commission of India also should now start thinking about looking into these matters. Okay, so this is my paper in brief. Let me now pause for a few questions, and if there are none, then I'll start explaining the main model of my paper.
Are there any questions at this stage? No. So Sesh, I think we'll continue. Yeah.
Yeah.
But you don't have much time, right? So you'll have to rush to the model.
Yeah. How much time
I'm
do
just
I
kidding. It's okay.
Yeah. So okay. So I got about a little more than 5 minutes. Okay.
You have about 10 minutes. Yes.
Yeah, 10 minutes. Yeah, I think that should be okay. But let's. Okay. So yeah, in the model, what I have is basically n firms. Okay. They are producing a homogeneous good in two independent markets, A and B. I have the inverse demand functions, just very general functions defined. Okay, so so then what I'm assuming is that firm is endowed with the unit budget, okay, that it's splitting between markets A and B. So it allocates, say, Xi to market A and 1 minus Xi to market B. And this is just a simplifying assumption, just to capture the idea that firms are weighing the opportunity cost of investing in one market against the other. Okay. Then every firm's marginal cost decreases with the amount of investment in that market. Okay. Now I keep these marginal cost functions different, but they don't play any role in the result. It's just to highlight that even if the marginal costs are different, it still solely depends on the curvature of these demand functions here. Okay, so what we have over here is a very standard Cournot model. Okay, nothing fancy, no special assumptions, except for the fact that we have this idea of allocation over here. Okay, so the net profit of the firm is, in the absence of any overlapping ownership, is just the profit margin times the quantity in each market. Okay, so this is the, so this is on the side of the firms. Next, we look at the side of the overlapping ownership. So as I mentioned that, we are assuming that all stakes are symmetric. So what that means is that firm I is putting some weight lambda between 0 and 1 on the profits of all other firms. Okay, so the payoff function is simply firm I's profit plus lambda times the profit of the sum of the profits of all other firms. The value of lambda between 0 and 1 depends on the type of ownership, okay, whether it's cross ownership, common ownership, etc. I won't get into the details in the seminar, but the interpretation of the extremes is independent of ownership. Okay, so lambda equals 0 simply means that firms are maximizing their individual profits, and lambda equals 1 is that it's either a merger if you have only two firms in the market, or a cartel if you have more than two firms in the market. Okay, so firms are simultaneously choosing investment and quantity, and all the consistency conditions for ensuring unique interior solutions are made and then analyzed. Okay, so the symmetric Nash equilibrium is denoted by the quantities in each market, QA, QB, and X. Okay, now I don't have the fourth 1 minus X because of the budget assumption. It's naturally decided for what investment will occur in market B. So therefore, at the investment level, we just need to look at X star and how that X star is going to change with common ownership. So so firstly, we have this first order condition here that determines QA and QB. Yeah, I mean, this is the standard Lerner modified HHI condition. Okay, I won't get into the details here for the lack of time. But the key idea is stated in this lemma is that assuming this investment X star is exogenous, the quantity tends to decrease always with common ownership, and it tends to increase with investment. Okay, so now the question is that how is this investment changing with common ownership? Because that's the only one that can drive the quantity up. And then we have to look at, which of these two effects are dominating later on. Now, the equilibrium investment is determined by this first order condition. What this means is that the marginal cost, the marginal reduction in cost from investing, okay, this is different from the marginal cost, which is usually with respect to quantity. Okay, so the marginal cost, so what's happening is that the investment is decreasing this marginal cost, and this decrease has to be equal across the two markets. What this FOC, this condition translates into that the investment X bar simply depends on the ratio of the quantities produced in market B and A. And if market A is more elastic, okay, that is the curvature is more, then as common ownership increases, the firms are going, there is a higher downward pressure on quantity A as compared to quantity B. Okay, and therefore the investment in that market is going to increase. Okay, so that's what is stated in proposition 1, that as overlapping ownership increases, the investment in market A is going to increase. And again, let me state the reason. The reason is that the quantity in market A is going to be more sensitive to increase in common ownership. That is, it's going to decrease by a higher amount than quantity B. And that's what's going to drive the investment in market A to go up. Okay. Yeah, so this, curvature can be stated mathematically as a parameter delta, okay, which is essentially the elasticity of the slope of the demand curve. That is, for a unit change in quantity, how much does the slope of the demand curve change? And yeah, it also relates with curvature. So if delta is greater than 0, then you have a concave demand function, and if it's convex, then if it's less than 0, then you have a convex one. Okay, so now the question is, okay, so as we explained here, okay, the quantity is always going to decrease, but the investment, if it increases, then it could increase the quantity. And over here, we see that supposing market A is the more elastic one, then the investment is increasing in that. And the question is that, is the increase in investment in market A sufficient to offset the decrease in quantity caused by overlapping ownership? And the answer is no. So overlapping ownership always decreases output in both markets, A and B. Yeah, the reason is just what I explained, that although the investment is increasing in the market with higher elasticity, it's not enough to offset the decrease in quantity. And the last proposition is about the producer surplus, that as overlapping ownership increases, each firm's sum of the profits from these two markets, A and B, always increases. So there is always an incentive on the side of the firms if they are doing cross ownership, or on the side of the investors if they are engaging in common ownership, to increase profits. Yeah, so over here, I'll briefly speak about spillovers, and then I have my conclusion slide. So, so you can have these two kinds of spillovers. Okay, so one is the inter-firm but intra-market spillovers. That is that the marginal cost of firm I decreases because of the investments of all other rivals in that market, okay? And it could decrease by some factor beta A, the same thing for market B. And well, I've checked this model mostly for the case where these two betas are equal. And because, you know, they are sort of, this is an allocation problem and they are offsetting each other, it doesn't produce the result that Lopez and Vives have shown, that the quantity, that, you know, if the spillovers are high, it can increase quantity. So the quantity, you know, despite spillover, seems to always decrease. The other case is a, you know, more milder case where you have intra-firm, that is within the firm, but inter-market spillovers. That is, my investment in market A drives down the cost, you know, to some extent in market B, and vice versa. Now, if, say, this spillover is 100%, then we are actually not looking at an allocation problem at all. So it doesn't really make sense to consider these spillovers, because you're actually moving away from the, so the higher the value of these gammas, you're actually moving away from the allocation problem. So in conclusion, spillovers are not changing my result, and it seems that common ownership overall has a anti-competitive effect on all the markets. Okay, so let me quickly conclude the paper. So we have seen that so we study a Cournot oligopoly model where firms are operating in two markets. These two markets are otherwise independent. They only differ, or the key difference that is necessary between them is the curvature of the inverse demand function. Now, firms are investing for cost reducing R&D in both markets, and then, you know, they are making output choices. They have a fixed budget which they are allocating between these two markets. Essentially means they are weighing the opportunity cost of investing in one market against the other. And then we have seen how common ownership alters this investment behavior. In the less elastic market, both the output and investment decreases. In the more elastic market, although investment increases, the output still decreases. And so we have a decrease in consumer surplus, and therefore a anti-competitive effect. And lastly, introducing spillovers does not affect the conclusion. And this challenges the idea by Lopez and Vives that having significant spillovers could be pro-competitive for common ownership or overlapping ownership overall. Okay, so that's what the paper is about. I have one slide for some new definitions for common ownership, but maybe if there is no time, then I could skip that. So.
I think we could maybe see if there are any questions.
Yeah.
And then,
Yeah,
are there
yeah,
any
perfect.
questions? Uday, this is the mic.
Hi. So this is very interesting theoretical model. I am Uday from Delhi School of Economics. Okay.
Okay.
So I would be interested in your last slide, although you have not shown it. That is alternative definition of common ownership, how the firms are optimizing in that particular framework. Here you have taken simply pi I plus lambda into summation of all the other firms' profit. But typically,
Yes.
firm I's own profits are also getting distributed among different investors. Okay. So your objective function, if it properly accounts for that aspects also, and even though they are non-controlling stakeholders, okay, so even then there should be some impact on that. That's number one. Second point is you have taken a fixed amount of budget being allocated. R&D budget is one, and that is being allocated between the two markets. Now, how does your model change if I simply assume that I will be able to make investment in cost reduction, say in market A by XA, and the cost of that particular XA reduction is half XA square. I'm taking the convex cost, R&D convex cost. Similarly for market B, I can reduce the cost by XB and the cost there is half XB squared, okay? So there I don't have the fixity of this R&D budget which is getting allocated in two markets. But now I have an open problem in terms of optimizing across the markets in terms of their productivity of the R&D investment. Okay, thank you.
Okay. Yeah. So let me answer these two questions. I think thanks for asking these questions. They're actually very nice, clarifying questions. Okay. So your first question was about the nature of the. Where is this? Okay. Yeah. So your first question. Yeah. So I think your first question was about the nature of this, payoff. And if I understood you correctly, you sort of have this comment that this should be, say, 1 minus lambda and lambda, where, you are also distributing this. I mean, firm I is not going to get 100% of pi I. I mean, it's going to be 1 minus lambda, which is the share that is left over after it, pays the profits to other firms. So, yes, you could also model this in that way. This form of modeling is equivalent to that. Okay, so yes, I mean, that's more intuitive, but you could just pull out, say, 1 minus lambda common, and there's just one parameter here which you can call lambda. So so these two are just equivalent ways of modeling. Yeah, about your other question on the fixed budget. So as long as you have a convex cost of total investment, okay, which is, say, you are investing X in market A and Y in market B, and the cost of that investment is, say, X plus Y squared. Okay, so you have this convex cost of total investment. What happens in that case is that the marginal cost, or say if I increase my investment in market A, okay, then it's going to increase my marginal cost of investing in market B, because the total investment is convex. And therefore, if I say increase investment in market A, it's going to make investing in market B more expensive, and that's going to want me to cut back investment from market B. Okay, now so all this does is it complicates the model a little bit. But the assumption of a budget essentially captures this trade-off by just simplifying and saying that it's a budget of 1. Alternatively, you can also think of this, convex total cost function as an extreme, or the budget assumption as an extreme form of this convex cost function, which is that, the cost is 0 between investment 0 and 1, and then it goes to infinity. So, by extension, this result should apply to sufficiently convex cost or the total cost of investment.
Krishna and then Shubhashish.
Thank you. Okay, I remember a General Motors story from my years with General Motors. Common ownership, the headquarters, and they switched to divisionalized system instead of functional. They promoted competition among the various divisions, and the company went on to do well. We also heard, so this is a case of common ownership leading to more competition and more profit for the common owner. Similarly, we also heard this morning about competition growing innovation. And so I was wondering, what is your intuitive story? The math is pretty straightforward and actually nicely done. What is the intuitive story that these big firms, these are mutual funds and so forth, and particularly with India in mind, will have a negative effect or can have a negative effect from the point of view of competition? And by way of comparison, in the USA, I'm a little hard pressed that a BlackRock will be able to influence Apple computer of $3 trillion and a Microsoft approaching the same to do something that BlackRock wants. So there is a certain degree of independence, at least of large firms, such that those firms are going to do what they do. So can you tell me something intuitively, what is it that is bothersome here? I haven't got that part of it.
Okay, so your first question is on innovation. You're saying that there is some evidence that common ownership promotes innovation. And the second one was about
more competition. I said common ownership can promote more competition, which promotes more.
Yes. So firstly, innovation is quite a broad term, and it's mainly classified into these two kinds. So one is the drastic innovation, where you have they're usually modeled as, say, patent races. These are very high risk innovations, and if your firm is successful at innovating or winning the patent, then you have some exclusive monopoly in the market, and in those cases the result can change quite significantly. However, the case my paper is dealing with is with process innovations, which are more or less deterministic. That is that if I, make some investment, then I'm, with a good degree of certainty, I know that it's going to reduce my cost of production by some certain amount. So, I mean, at least theoretically, I'm showing that in case of these, specific process innovations, there seems to be no, I mean, in one of the markets, I also show that innovation or, the investment is increasing as a consequence of common ownership. But that's not really translating into lower prices in the market. So, at the end, at least in Europe and the US, as of now, okay, things may change, but they are mostly concerned with prices, which boils down to consumer welfare. So that's what my paper is arguing, that yes, although innovation increases in some markets, it's not significant enough to benefit consumer welfare. Okay, now about your second influence on the mechanism by which investors can influence the managers of the firms. So I think that's a great question, because there's already, I mean, this itself is under high debate. Now, yeah, I mean, you have actually both camps. There are some papers that are saying there is no effect. There's some papers that are showing effect. Uh, so yeah, I mean, I sort of, based on the papers, I feel that there is an effect. There is a recent paper by Anton and co-authors, which is, also now published very well. And the mechanism they propose is that the common owners, okay, control the performance incentives of the managers, and thereby, okay, are able to influence their decision making. And this actually brings me to my, the slide that, I mentioned about alternative definitions of common ownership, which is that what they're arguing is that this effect is only at the top management level, which, influences investment or effort, which is equivalent in theoretical terms, but not the lower management decisions like prices and quantity. So they have a model, and also they have some empirical evidence where they're saying that this common ownership is only influencing at the investment level, and the pricing and quantity decisions are made independently. And even this has the potential to produce anti-competitive effects. So yeah.
Shubhashish? Sai, SG here.
Yes. Yes.
Sai, just going back to Uday's question, yeah?
Yes.
I think the way I would have asked the question is the following, that you're doing constrained optimization for one of the firms, because the other firm must have 1 minus xi, right?
Yes, yes.
Whereas if I were allowed to choose the x's separately with the constraint that xi plus xj must be less than equal to 1, right? Then I can't see the result that you are claiming. I guess that's what Uday's question would have been, right?
Okay, so you don't really need the constraint that x plus y is less than equal to 1. What you need is that x plus the cost of investing x plus y. Okay, let's call it a function tau of x plus y. Now this function tau has to be sufficiently convex. Okay, now think about that it's extremely convex. Okay, if it's extremely convex, then this function is going to be something like almost the cost is going to be almost 0 between 0 and 1, and then it's going to go to infinity. Okay, which is exactly the budget assumption. Okay, where you are saying that my investments x plus y have a total cost of 0 between 0 and 1, and then it's somehow going to infinity.
No, that will not do. That will not do, because that will also not allow you to choose anything other than 0 or the full budget. What I'm saying is that if there is a slack, I leave some budget not spent. I should have that choice, right? I don't need to invest in both the markets, or I don't need to invest all of my funds in both the markets.
Absolutely. So, so in that case, what will happen is that so you will have this effect. So you will have one effect on the total volume of investment, okay, which in this case, will decrease. Okay, so this x plus y, the total amount of investment with common ownership, should ideally decrease. What it will not affect is the allocation problem. That although this x plus y, the total volume is decreasing, the firms are still increasing their investment in the market which has higher elasticity, and decreasing in the market which has lower elasticity. So yes, you're right. I mean, the total volume would in all likelihood decrease, but the allocation problem, and that's the main point of the paper, trying to study the allocation problem, or how the firms are weighing the opportunity cost in investing one market against the other. So if this cost function is sufficiently convex, then the incentive to cut the total volume of investment is not very high, and that would, still retain this property of increasing investment in one market and decreasing in the other market. Yes, obviously. I mean, if it is linear or it's not very convex, then yeah, the result would break down.
Thanks, Sesh. So we have the last. Gaurav, are you Gaurav, are you here?
Hello, yeah, I can hear.
Hi.
Hi.
Okay, so we have the last presentation for the day. Gaurav is going to talk about his paper on integrating a free online service and competition and welfare implications of that. Okay, so Gaurav, you have 30 minutes to present, and then is Nilanjan here? Yeah. So then we have about 5 minutes for the discussant and some questions from the audience.
Okay. Okay.
Thanks.
So shall I start?
Yes.
Okay, so thank you for inviting me to give a talk on my research work. So this paper titled Integrating a Free Online Service, Advertisements and Competitive Implications, it's basically based on understanding the issue of incompatibility or adopting a closed ecosystem approach in the digital market. It's my single author work. To begin, let me start making a definition about what do I mean by a free online service. So when I say a free online service, I basically mean a platform. So for instance, we can think of a platform as an app store, an application store, and it's serving multiple sites. So there's a user side who is trying to, consume apps by going to the app store. Then there's a different side. The site consists of, for instance, certain advertisers who are trying to reach these users by placing certain ads on this app store. So this app store is a platform which is going to serve different markets. Okay, so let me set the stage first. Let me briefly give a motivation for my research question. And to proceed, I will focus on one example, that is of the smartphone market. And what is happening in smartphone market is that we all know, we all use smartphones, and its importance is very much in our lives. We use it for different activities. And as its value has increased over time, it has also been under scrutiny by the competition authorities. And there are a lot of practices that these companies engage in, exclusionary and exploitative practices, which potentially can have adverse impact on the competition and can reduce the consumer welfare. Let me focus on one issue, the issue of closed ecosystem and incompatibility. So the question that is to be answered is, if there's a dominant smartphone firm, would that firm has an incentive to exclude the rival apps by adopting a closed ecosystem? I'll come back to that, what do I mean by that. And as a result of that, would that lead to a decrease in the welfare of the consumer? So that is the question that is being debated. And there has been some literature, and I'll talk about this literature once I present my main result and how I link those results with my previous economic literature. So this literature has talked about various effects of adopting this incompatibility or closed ecosystem approach. Let me just give what is the takeaway of my paper. It's basically, I will give a new rationale for explaining this approach of adopting a closed ecosystem. That is one. And the other is understanding the welfare effects of this closed ecosystem approach. Now, to understand those welfare effects, of course, we need to look into those different market conditions. And as I will explain later, the crucial innovation that is in my paper is about introducing the ads in the basic framework and how we use that ads and the modeling of that ad to understand the welfare effect. So I do it by understanding how those ads affect the utility of the consumer in the market. And what I mean is how much consumer dislike advertisements. So I try to link to one essential market parameter, that is consumers' aversion to advertisements, and how that will affect the eventual welfare effects of adopting this closed ecosystem approach. So this is my main summary of my main paper, if I have to say that. Okay, now let me try to go into the details. So as you can see, there are two images on the slides. So um, there are two smartphone companies, two dominant smartphone companies. On the left, we have Apple. And for an Apple, we have a product, okay, iPhone. And that Apple also have its own service, a free online service that is App Store. Now, if you look closely into the App Store, there will be certain ads placed inside that App Store. Okay, so there are certain ads in the App Store. So App Store is a platform, as I was explaining, what is a free online service. It's a platform because there are users who are using these app stores to access the apps, and there are advertisers also who are trying to access these users by placing certain ads in the application store. Similarly, we have Huawei. That's another dominant player in the smartphone market. And again, we can see there's a product, there's a hardware, Huawei phone. And Huawei also has now its own application store, and it's known as App Gallery. Again, if you look closely, on the interface of this App Gallery, there are certain ads placed on it. So again, it's operating as a platform, this App Gallery. So there are ads in it, and then there are certain users who are trying to download and use apps by accessing the App Gallery. So each of these firms, Apple and Huawei, has a product and a service. Now, based on this example, let me collect certain observations. The first observation is that both firms own a product, and product or hardware, I will use that interchangeably, and there is a service. So Apple has iPhone, and Apple also has certain services, and those services have ads in it. Okay, Apple has App Store, Apple News. Again, similarly, Huawei has a Huawei phone and its service, App Gallery, and Petal Search is Huawei search engine basically. Now, how do these firms monetize it? So there's a paid product for these firms, that is their hardware, that's a smartphone, and then there are certain free services, and these free services have ads in it. So that is a crucial innovation in my paper by introducing a different market structure over on the service side, and I'll come back to again as I proceed. Okay, now one more observation we can see that Apple iPhone has more functionalities. So I think there were certain restrictions on certain apps being used on Huawei phone. So I think of Apple iPhone as a product which has more functionalities in terms of number of applications that it can give you. So that is another observation. Now the crucial thing is right now both these firms, Apple and Huawei. So both these firms are using a closed ecosystem approach. In economics, we also call that an incompatibility approach, or we call it comparative bundling. What I call it is service integration. That's exactly what it is. It's basically making your system, which is consisting of a product and a service, incompatible with the rival system. So currently what these firms are doing is, so Apple has its own system now, closed system, that is an iPhone plus App Store. And Huawei has its own system that is of a smartphone with App Gallery pre-installed in. Now, when I say a closed system, so you can't use an App Store outside iPhone. App Store is not available outside iPhone. And you cannot use any other application store on the iPhone currently. Similarly, for Huawei, Huawei now has its pre-installed integrated App Gallery, that is an application store, and other app stores are not working with, for at least App Store is not working with. And so this makes these two systems, that is of iPhone plus App Store, one system, and Huawei plus App Gallery, that is another system. Now, based on these observations, I'll try to examine few questions. One is, what are the market conditions under which this service integration or an incompatibility approach is a profitable strategy for either of the firm? The second is, that is more important from an antitrust point of view, can a dominant firm leverage its quality advantage by using this service integration approach? That is by integrating the product it has and that is a dominant product because of a higher quality in the eyes of the user, and the service. So these are two questions which I'll try to answer in my discussion. Now, let me very briefly tell you about what is my framework, and when I do that, I won't go into any maths of it. But I will tell you what is the intuitive explanation about, what are the various players doing in my framework. So the market structure, as I just explained in the observations, there are two firms, and let's think of two firms as G, and let's say G is Apple, and there's one more firm, firm S, and that is Huawei. Okay. And each of these two firms have two components. There's a product and there's a service. So firm G and firm G is Apple. It has product. Let's label it as G1. Okay, and it's iPhone. And there is a service. Let's label it as G2, and that's an app store for the Apple. Similarly, for firm S, there's a product. That's a Huawei phone, and there's a service, App Gallery, and let's label it as S2. Okay. Now, again, the products in my framework are paid, and the crucial difference comes on the services side, which I model as a platform. When I say a platform, these services are free to us, free to the users, but there is one more side attached to it, that is the advertisers who are trying to place ads in the service to reach out to the users who are using these services. Users demand at most 1 unit of product and services. And there are advertisers who are trying to reach these users by placing ads in the services. So these are the main players in my framework. Now, some comments about the attributes of products and services, and that links to the user preferences also. So there is vertical differentiation in my framework. Basically, that means there are two products, and two products have different qualities in the eyes of users, and users see one product as a superior product. Okay, so in my case, firm G, which has a product G1, that is going to be a superior product because I'm based on my observation, I'm saying firm G is iPhone, and iPhone, as I said, has more functionality, which I interpret as having superior quality. On the services side, in my baseline framework, I take it as no similar qualities or identical qualities, but yeah, I have done extensions and I've looked at that my main results, the main intuition of the results that easily follow through that also. There is also horizontal differentiation in my framework. When I say horizontal differentiation, so if there is a set of users who are trying to decide which product or which service to consume, then they have a difference in their taste in terms of in terms of the different characteristics of the products and services. Okay, so for instance, there can be differences between the two products and services in terms of user interface. Of course, iPhone is user interface is not the same as the interface of the Huawei phone. They can difference in design, they can difference in performance also. So these differences between the two products and services and the differences in the taste of the users for these attributes of the products and services lead to some users going to product or service of Apple, and some users going to product and service of Huawei. Okay, so there's both vertical and there is also an horizontal differentiation in the framework. Now, without going to the question, the user utility function, let me just briefly tell you what are the trade-offs that a user faces when the user is deciding which system to consume. Okay, so on the user side, there is of course benefits, and those benefits comes from some standalone utility, from using a phone, Huawei phone or an Apple phone. There is some value from that, but they also have to incur certain costs. So one cost in economics, we call that transportation cost, and we also call that a misfit cost. And that misfit cost is arising because these products and services are differentiated in terms of user interface, in terms of certain horizontal attributes. And because of their differences in these horizontal attributes, and users compare these attributes differently. User preferences are heterogeneous. So some user would prefer, would have some ideal preference for one attribute vis-a-vis the other attribute. And that leads to misfit cost, because the attributes of these two products and services will not exactly match with what users were expecting. So there's a misfit cost in the model for both product and service. Then obviously they are paying a price for product. It's a cost. That brings a disutility. Now the crucial element is that you should take away from this slide is regarding the nuisance cost. Now what is this nuisance cost of ads? So the way I'm modeling advertisements in my model is, when you place these ads in the services, so users are exposed to these ads. Users have to consume these ads because these ads are bundled with the content of the services. Now, in my framework, I think of these ads as being imposing a disutility to the users. And in economic, one term for that is nuisance cost of ads. That is basically a disutility imposed on user because they have to consume these ads. Okay, so based on these trade-offs the users have, so they evaluate these trade-offs, they evaluate the benefit and the cost of using different options, and then they are trying to decide which option to consume. Now that option will depend what is the market regime that is in place. So I look at two different market regimes. One, which I call independent pricing, which is basically a market in which the users can mix and match different products and services. So there is compatibility between different products and services. So since there are two firms and each firm has a product and a services, in total we can have 4 different mix and match systems. Okay, so G1, G2 means user is consuming product of firm G and service of firm G. So user is using iPhone and the App Store. Then G1, S2 means user is consuming product of firm G and service of firm S. Similarly, S1, G2 system means user is consuming product of firm S and service of firm G. And S1, G2 means user is consuming product of firm S and service of firm G. And this is because there is compatibility. Both firms have not adopted incompatibility. So users can always mix and match. Now, if either of the firm adopts a closed ecosystem approach that they make their product and service incompatible with the arrival system, then of course we can only have 2 systems for the users. So if either firm G or firm S makes their system incompatible with the arrival system, then the option that will be available to the users are in one, G1, G2. That means you consume product of G1, but you also have to consume the service of firm G. Or S1, S2, you consume product of firm S, but you also have to consume the service of firm S, which is integrated with the product. So there are only 2 systems available under the service integration regime. Okay, so these are the user options under the 2 possible market regimes. And then there's a final side, the advertising side. So these advertisers are trying to reach these users by placing advertisements in the services. And I look at 3 important factors that determine the business impact. What is the value they get from placing an ad? One is, what is the nature of product? It can be, for instance, general or specific. For instance, advertisements about apps, for instance, like communication apps, which are going to attract a broader audience, they have a higher value in my framework. And then there can be specific apps which will only cater to a very narrow audience. For instance, learning a specific language app, so they will attract a very narrow audience. Okay, so nature of advertising product will determine what is the likely business impact. Then, of course, what is the likelihood that a user would click on that ad? That is another thing. And finally, the number of users these 2 services would attract for the advertiser. That will definitely determine what is the demand for the advertising products. Okay. So these are the 3 different factors which I model on the advertising side. Now I use this framework And the equilibrium concept I used is standard from game theory, that is subgame perfect Nash equilibrium. And solving that framework, let me just tell you what are the main results that I obtained from my framework. Now, before I do that, let me first tell you what are the trade-offs. What are the effects that I have in my framework as I compare these two market regimes. One of independent pricing, in which the users can mix and match. The firms have adopted a compatibility approach, vis-a-vis a service integration market regime in which the systems are not compatible. So if a user consumes product of firm G, the user also has to consume the service of that firm only. Okay. So what are the main trade-offs that I find? So one is, how will this affect the segmentation of the market? Now, when I say market segmentation, what I mean to say is which side of the market you will use mainly to monetize yourself. So for the dominant firm G, what I find is there'll be increased demand as we move from independent pricing to service integration. For the dominant firm G, the demand for its service will increase. And that's intuitive also. The explanation is because this firm has a higher quality product, it can use that higher quality as a leverage to improve the demand for its service under the service integration regime. For the rival inferior firm, the opposite happens. So that firm is able to increase demand for its product. Now, why that happens? Because dominant firm has integrated both service and the product, then there are certain users whose preference mismatch with respect to the system of firm G will increase. Okay, so these users would want to switch and consume the rival system firm as the firm as product with the service in it. So that leads to an increase in the demand for the firm as product. So essentially, market segmentation leads to a strategic differentiation in the customer base of the two firms. So firm G is able to increase the focus on service by increasing the customer base for service. And similarly, firm S is able to increase its customer base for the product. So that is what I mean by market segmentation. Okay, now, as a result, as we move from independent pricing to service integration, there is an effect on what are the prices that this firm can charge for the products. So in my framework, only products are paid. The services are essentially free with ads in. So the effect on price competition depends, one, how the market power changes. And what I find is market power will increase. Now, there's an intuitive explanation for that. So suppose I have two products, I have two hardwares, and in both the hardwares, I am pre-installing exclusive services. So for instance, Apple has an exclusive app store and Huawei has an exclusive app gallery. What essentially that means is I am increasing the differentiation of the products in the eyes of the consumer. And that means I am reducing the responsiveness of these consumers to price changes, which is leading to an increase in the ability of these firms to charge a higher price. So this puts a upward pressure on the prices of the product to increase. So market power increases and prices will increase. Now, the second effect on price competition comes, that is a result from the platform market literature, and that says, so that what is the result? First, let me explain what platform market literature says. So there is if a firm is competing on the two sides, as a user side and the other side which they're monetizing, and if they're competing intensively for the user, so what they can do is they can pass on certain profits that they obtain from the other sides to the users as lower prices to attract more users. That is the result from a platform market literature. And that is something very similar is happening here, which I call advertising revenue effect. Now, services, as I said in the first slide, is a platform. Okay, so there are users who are trying to use apps using these services, and there are advertisers who are placing ads in these services. Now, when these firms compete in the service integration regime, they're trying to compete intensively to attract users for their product. And they're, of course, obtaining certain advertising profits from the advertisers. Now, when they compete very intensively for the products, they pass on certain profits that they obtain from the advertising side to the users as lower prices. Now, if they do that, then there's a downward pressure on the prices as a result of adopting this service integration regime. So this is intuitively what are the main effects that are playing in my model. And of course, depending on what market conditions there are, the strength of these effects would change, and that would eventually determine what are the market outcomes and of course, what are the welfare implications. So let's try to see that. I'll state my main proposition through this figure. So I'm comparing firms' profit under the two market regimes, that is of independent pricing and service integration, that is a regime of compatibility vis-a-vis a regime of incompatibility. Now in this figure, you see on the horizontal axis, I have labeled it as nuisance cost, which basically tells me what is the user aversion to ads, how strongly the user dislike the advertisement that they have to consume from these services. Okay, the higher this number is, the greater the aversion to advertisements. On the vertical axis, it is labeled as quality advantage. It essentially says what is the advantage of the dominant firm product over the inferior firm products. So basically, what is the difference between the quality of dominant firm and the quality of inferior firm? And I label it as quality advantage. Now, given these...
Gaurav, hi. There is a clarificatory question. Just a sec. So I'll ask the question. The question is that if ecosystem G is closed, then what does an open ecosystem S mean?
It basically means, so yeah, that's a good question. So either firm G closes the system or firm S closes the system, we will lead to a eventually essential closed system. That's why I'm saying there are only two systems possible eventually. So in an independent pricing regime, no firm has a closed system. Okay, so both firm G and firm S adopted a open system. So users can mix and match products and services. But under the service integration regime, if either firm integrates the application service with the product, then that means their system is incompatible with the rival firm system. So it basically means either firm do that, then we are in the closed ecosystem in which the two rival systems cannot be used in any way together. So user has to basically have two options of consuming the firm G system or firm S system.
So in the graph, what is the difference between regime 2 and 3?
Regime 2 and 3, I'll come to that.
Okay.
Okay. So let me explain this graph now. On the horizontal axis, we have nuisance cost, as I explained, and on the vertical axis, I have quality advantage. Now, as you can see in this figure, there are three regions which I have labeled. And what these three regions tells me, what are the incentives of these two firms to adopt service integration? Okay, so in region 1, both firms have no incentive. I mean, their profits are higher if they adopt no service integration or they adopt independent pricing. In region 3, the other extreme, both firms want to adopt service integration. Okay. In region 2, firm G, which is a dominant firm, wants to adopt, and the rival firm would not want to adopt. Now, essentially, in region 2 and region 3, ultimately you get into a closed ecosystem, but the profitability of that will differ for the two firms, depending on which firm profits from the service integration. Now, let me explain intuitively based on the trade-offs that I was showing, why these three regions, why I'm getting these three regions. So let's start with region 1, in which no firm has an incentive to adopt a service integration approach. And the reason for that is the market segmentation, that is the increase in their customer base by strategically differentiating across the customer base, that is very weak. At the same time, the intensifying of price competition, because you are passing on the advertising revenues to the users in the form of lower prices, that intensifies price competition and that dominates, and that leads to a downward decrease in the prices of both the products. So weak market segmentation effect plus the downward, the decrease in the price of the product for both firms, that lead to a decrease in the profit of both firms with service integration. So no firm would want to adopt that approach in this region. The other extreme case of the other extreme situation is of region 3, in which market segmentation is very strong. That is, both firms are able to strategically differentiate themselves by focusing on different customer bases, and the market power increase because their products are also highly differentiated because they have their exclusive services. That effect also plays very strongly, and that counters any passing of advertising revenues to users in the form of lower prices. And eventually that tends to improve and increase the prices of the products of both firms. And that's why both firms are actually benefiting from this service integration regime. Now the asymmetry comes in region 2. That is where one firm benefits, the other firm loses if there is a closed ecosystem approach. So the reason why firm G is benefiting is because for firm G, the market segmentation and the price that firm G can charge, that goes up. But it's the other way reverse for firm S. For firm S, there is because of market segmentation, it gains some user base, but it's not able to monetize the user base effectively. And that leads to a decrease in profit for firm 1 under the closed ecosystem or service integration approach. So we see in region 2, there is an asymmetric effect of a closed ecosystem or service integration approach on the two firms. And this is the region which is more important from an antitrust point of view, which I'll come to now. Before that, let me very briefly explain what is my contribution to the literature. So there has been some literature, understanding incompatibility between firms or the approach of comparative bundling across firms and how that improves profit. So there's a classical literature starting from 80s, Matthewson, and then Zhu, and then Kim and Choi. And so all these are also looking market structure very similar to me. They all, again, they have different components, but for them, all components are paid. Okay, and the reason they find that incompatibility would lead to intensified price competition and reducing profits for both firms is because with incompatibility, firms internalizes the effect of their price decrease on their all system components. And that leads to a downward pressure on their prices, and which leads to a reduction in profits with incompatibility. In my paper also, so basically to see, because this literature is basically with symmetric products with no difference in quality. So I did some extension in which I looked at what results I get. So in my literature, in my paper also, I also see the same effect, that with incompatibility, profits go down. But the mechanism, the rationale for that is different, because the structure of services in my paper is different, which is a free service with ads in it. And the rationale for explaining why the prices are going down in my paper is because there is passing through of advertising revenue to users in the form of lower prices, unlike the previous literature. Then some literature extended this in initial literature, and they introduced this quality advantage, some firm having some advantage over the other firm. And again, they had paid components, and they tried to explain the impact of incompatibility in profits, depending on what is the change in responsiveness of consumer to system price. And again, in my paper also, this I showed in the figure, it can lead to increase or decrease in profit of the firms. But again, the rationale for that is slightly different. First, this previous literature does not have advertisements in the services. So of course, the implications for the profit will definitely change. And that is the crucial innovation which I introduced, and which will lead to a different result in my paper. Okay, now let me just connect my results with what we can take away from a managerial perspective and the policy implicator perspective. So one implication is that there is an increased focus of dominant firm on monetizing the services. So first, as I said in that figure, okay, coming to this table, there are 3 columns. One is stating the difference in product qualities. Then there is the incentive of the firm to adopt service integration or not. And then there is a third column which gives an example of that, approximately close example. So if there's a very small difference in the product qualities, then service integration is not a profitable strategy. That is the one integration we can take. And we have seen in recent past that Amazon and Google, they opened up their system for Fire Stick and Chromecast. And initially they used to be closed. They didn't allow rival services to be operated to be compatible with their hardware. But now, because there are very small differences in their product quality, so this is one example which can be related to my result. Now, the crucial is when these differences are large, which we are seeing in the smartphone markets. And as I said, based on my results, service integration is a profitable strategy for the dominant firm. And the reasoning I gave was, it helps dominant firm to increase its profit from the service dimension. Now, if we look at recent example of Apple, Apple has been integrating its lot of different apps with a smartphone. And based on some data which I went through, that their revenue from the services is also going up at the same time, which offers an explanation as why Apple is integrating these apps, and as a result of these apps, why the revenue of the Apple from the services is going up. Okay, now coming back to my figure, as I said, region 2, in which there's an asymmetric effect of service integration of firms' profit, that is very crucial from a antitrust point of view, because there's a threat of leveraging market power, because there is dominant firm which wants to use its market power or the higher market share which it has because it's a superior product to enter and increase its customer base in the service dimension, and that would lead to, for the rival firm, which is an inferior product firm, to reduce profit. Okay, now if there is a leveraging threat in region 2, then the crucial question becomes, what should a regulator do? When should a regulator enter the market, or what should the regulatory intervention? So again, we have to go back to understand first, what are the trade-offs the regulator will face while intervening, and those trade-offs would determine what is the impact on the welfare standard we use, whether we use user or social welfare. Now, let me very briefly tell you what happens if we adopt a closed ecosystem approach. So there are 3 columns: impact on service integration on users, then there's a benefit to them, and there's a cost, because welfare effects has a social benefit and a social cost. So from the user point of view, benefit comes because overall the users are consuming a superior system, the dominant firm which has superior product. So that from an aggregate point of view is a benefit to the users. And they're also have reduced exposure to ads. Now, I didn't explain it earlier, but what I find in my paper is under the service integration approach, the firms in equilibrium would decrease the number of ads that are shown to users. Now, if there's a decrease in the number of ads shown to the users, of course, the disutility that they obtain from consuming these services because they're exposed to ad, that will also go down. Okay, so there's a benefit to users because of adopting this service integration approach. The cost is because there's a preference mismatch. The users are forced, instead of mix matching any product services, now they're forced to consume system of one firm vis-a-vis the system of other firm. And prices can increase. If price increases, then it's the cost to users. On the advertisers, the cost is because in the equilibrium, firms are reducing the number of ads that are shown to users. So of course, ad revenues will go down, and that becomes a cost to users. Now, based on these costs and benefits, I try to highlight what are the market conditions under which users or advertisers would suffer. So the crucial parameter for me is what is the user aversion to ad, and which I call the nuisance cost of ads in my model. So depending on what is the strength of this nuisance cost of ad, the welfare effects would be determined, and that would determine what is the final regulatory intervention. So when the user nuisance cost is very small, then users suffer. Why? Because the reduction in the ads with service integration, that is very small. And advertiser suffers because ads are being reduced. Okay. So if both users and advertisers are suffering, then in equilibrium, what I find is a regulatory intervention can have one clear prescription, that is to intervene, at least from the user point of view, consumer welfare point of view. If the aversion to advertisements is very strong, then users become better off because the advertising quantity reduces sufficiently which sufficiently reduces the user exposure to ads and which essentially dominates any other effect playing in the framework, and that makes user better off with adoption of service integration approach. And of course, advertiser again suffer because the ads are going down, the advertising revenue is going down. So in this case, regulation intervention is ambiguous depending on whether you go for social welfare or whether you go for a user welfare standard. So to summarize the main takeaways from my paper, what I find is if there's a closed ecosystem approach or service integration, then there are three distinct effects which would determine what would happen to firm's profit. One, market segmentation, that is how strong the strategic differentiation of the customer basis for the two firm is, then how strong the product differentiation is, and what is the pass on of advertising revenues to the users in the form of lower prices. And as I said, if the difference in product quality is sufficiently large, then both firms can effectively monetize these different component user bases. Whereas for an intermediate difference in product qualities, that is where, from an antitrust point of view, leveraging is a crucial issue, and dependent on the strength or the level of nuisance cost of ads that user perceive, that would determine what should be the nature of a regulatory intervention. So thank you. I'll stop here. Any question, comments that are welcome.
So Nilanjan, is Nilanjan here? Is he here? Where is he? Thanks, Gaurav. We are waiting for Nilanjan to. I think that has been there since the morning. Hi. Good afternoon, Nilanjan.
Okay, thank
Hi.
you. Yes. Just one second. Okay, I thank, am I audible?
Yes.
Okay. I thank IDF so for giving me this opportunity, as well as I thank Gaurav for such a nice presentation. I had the scope of going through your paper, means that's really nice. Okay, Gaurav, can you share the screen once? Because my question is related to your diagram first, then I can ask you some technical question. Means
Okay.
where you are showing the three zones.
Okay.
Yes.
Just a second.
Just any of the diagram will do.
Yeah. Just okay.
Yes, that's fine. Okay. So the question is that in this diagram, in the y-axis, you are measuring the quality advantage. Okay. And so you are assuming that the farm G is selling a better quality product than farm A, the other farm. Okay. And this quality advantage you are measuring the paper in terms of, say, delta, the difference. So that means, say, if I now compare, say, zone 1 and, say, zone 3, say, for example, okay? So that means when I am in zone 1, right, that means zone 1 is better in terms of the quality for farm A's.
Yeah.
If I'm correct. Okay, and in zone 3 means farm A's will not like that zone because the quality advantage is much higher for the other farm.
So firm S would want to adopt also service integration regime in region 3
No,
because
I'll come to that. I'm just classifying the zone in terms of the quality advantage. Okay.
yeah.
So
Okay, yeah.
the question that comes to my mind is that if I choose, say, zone 1 or say zone 3, I'm getting a symmetric result in terms of both the farms. That says in zone 1, both farms adopt independent pricing, right? And in zone 1, with respect to zone 3, I will say that for farm S, that's the better zone. Similarly, if I move to, say, zone 3, farm A's will not like that zone because the quality advantage of the other farm is much higher. But in that zone also, I get a result where both the firms are adopting service integration. So if you can explain this part, then I have some few technical question. I will come to that later.
So in zone 1, in region 1, neither firm wants to adopt the regime. That is what I'm saying.
So,
Because
but there is a symmetric results. But in zone 1, this is better for farm X. That is what I'm saying.
But so firm S, if firm S compare its service integrity regime in zone 1 with respect to zone 3, that's your question?
No, see, that's the characteristic of the zone. That's fine. But in terms of the observation, I'm getting a similar result, say in zone 1, zone 3. Both are doing. That is my question.
No, it's not similar in the sense that the equilibrium outcome finally I'm getting, that is different. I mean, so in zone 1, I'm not adopting a closed ecosystem approach. In zone 3, I want to adopt a closed ecosystem approach. So that means essentially the market outcomes that we will see are going to be very different in the two zones. They are symmetric in terms of what firms adopt, but they are not symmetric in terms of
integrate or not, it's symmetric.
No, it is not symmetric in terms of integrated. No. Yes, it is symmetric in that sense from firm point of view, but essentially the final market regime that we see, those are totally different. In region 1, we see an open ecosystem or independent pricing market outcome, what is happening. And in region 2, region 3, both firms want to adopt closed ecosystem, and that means the market outcome would also be a closed ecosystem.
So if say let's just pick say zone 3, right? Both are adopting the service integration.
Yeah.
But with respect to farm 3 is in a much more disadvantageous position because the quality advantage of farm G is much higher. That was my question.
But that should not. I mean, essentially, it's a 2x2 matrix. I mean, 2x2 game. So essentially, that
in terms of understanding the logic, I found it little difficult. So for that reason, I just ask you. Okay. Apart from that, means there are few technical questions related to the model. Okay, it means you haven't shown here, but you have finally considered a hoteling structure where the horizontal product differentiation has been characterized in terms of two components, that is say X1 and X2, right? So my question related to that is that means in terms of defining that indifferent consumer.
Yeah.
Say for example, in case of independent pricing, there is a possibility that say a consumer may be indifferent in between G1, G2 as well as S1, S2. But I haven't found that in the paper. Maybe you can tell something on that. That's one point. The second point is related to this part because this is difficult to model or say handle because you have two component X1 and X2 and that is characterizing the horizontal product differentiation. So for that later you have defined a density function, right? So to close it, but you can check it later. I was just doing some calculation and I found that say for a case where Y less than half, the demand for the high quality farm may be lower than the demand of the low quality farm. So I did some calculation and I found and means just you can just check it because I don't think that will be the case. But second thing is that any justification in terms of the density function or the probability function that you are considering for the average location of the user because that's the thing.
So I think I'll start with the second point that you're saying regarding the density function. So one thing is in the framework.
Gaurav, Nilanjan, sorry to intervene, but you know, since none of us have seen the model, it's we
I'm not.
We can't comprehend the question.
Nishant.
Sorry. No, we're not complaining.
Okay, I don't have anything more. So no, that's fine. Yes.
I have no technical details.
So we are not complaining, but what we could do is why don't we see if there are any questions in the audience from here, and then maybe we could move to a more technical discussion. But are there any questions from the audience here? Yeah. So first her, and then you, Shubhashi.
Probably probably a trivial clarificatory question.
Yes.
Gaurav, can you stop your screen share? It will be easier for.
Yeah, yeah. Yes. It's fine now.
Am I audible now? This is probably a trivial clarificatory question. The nuisance cost that the consumers face, is it in net of the utility that they get from the advertisement? Because if there are no benefits from the advertisement, why would advertisers want to how would they get revenues from it? Why would they even want to be on the platform?
Yeah, yeah. Okay, so that's a very good question. So for when I'm interpreting utility, it's basically I'm saying there might be some benefits of ads to the user, but the dominant effect in my framework is that essentially it imposes a nuisance to the users. So whatever the benefit might have been to the users, that is very small, and on net, it's a negative effect for the users. Now, why advertisers would still want to place ads? That's a different question, because that depends on whether they get a demand for their ads on a service or not. Okay, and that depends on whether we have some other way to provide a positive demand to advertisers. That's why we have this differentiation in the eyes of users in terms of products and services. Now, because these products and services are differentiated for the users, no user would always go to single product or service, because their tastes are different, their preferences are different. So even though they will get a negative nuisance, on net, a negative disunity from ads, they would still want to purchase a firm's product or service. And because there's a positive demand for that firm, that would mean advertiser, even though they place an ad, they will still get a positive revenue.
Essentially, they will just purchase something despite being annoyed by the ad. Like they will purchase that product despite being annoyed by the ad.
Yeah, I mean, if you go into the micro foundation of that, because I have not done that micro foundation, but yeah, that is essentially it would be meaning.
Okay. Because they've seen it enough number of times and they're like, okay, fine, I'm just going to purchase that product now. I don't
Yeah,
want
yeah.
it. Stop bothering me.
I can't hear.
Can you hear me now?
Yes, yes, I can clearly.
Excellent. See, just one quick question. I'm sorry Nilanjan brought up X1, X2. So I have to ask, what are they? I can understand, so the horizontal differentiation is both in quality as well as in the nuisance of ads?
Okay, so the question is, what is this differentiation in terms of horizontal and vertical in my framework?
That's right, huh? Which one is which?
Yeah. Which one is which? So vertical, when I say vertical differentiation, that means one firm has a superior quality. And one example I gave was Apple has more number of apps. For instance, when I was writing this.
So that is neither X1 nor X2.
Not X1, not. What is X1, X2 first?
I don't know, that's what Nilanjan said. That's why I'm asking.
Okay. Because in my presentation, I'm just talking in the presentation, so I don't know what. So basically, X1, X2 determines. I think in my paper is that what is usual ideal variety for the product and the services, and those X1, X2 are basically determining in terms of the horizontal attribute where users are located on an link line.
So they are the location points.
Yeah, they're the location in the paper. Yes.
Okay, okay. Now I understand. But then let me ask this question. Right? That in region 2, which I thought was a very interesting implication that you drew, which is that this is exactly where there is a foreclosure risk, and therefore this can be used as a strategy to bankrupt the other firm and hence have a monopoly. I presume that's what you're saying.
Yeah.
Now, how much of it would be still valid if in addition to Huawei and Apple, there is my Bhanja's company producing cell phones, right? So, so that if there is a buffer out there, then how strong is this foreclosure risk?
Yeah, so if I have to extend my model, as you're saying, to more than to three firms at least, is that the
Where one
question?
firm is not, especially.
Yeah, in not. So that's a good, yeah, that's again, so basically what my effects right now working is in a two system. My model predominantly applies to a framework when there are two dominant firms in the market and they are the major players in the market. So suppose there are three players, then, these trade-offs and everything, of course, the entire effects would be different. So yeah, that can be different paper totally.
No, what I'm trying to say is that, pushing this a little further, is that the foreclosure risk happens because there is no other market, right? But now your firm 2, or sorry, firm S, right? It can open up its service to that third firm and hence expand its market in services, right? Which will also be beneficial for the third firm. Because the third, to take an extreme example, suppose it was a feature phone, right? So many of the apps could not be used because it required, the same thing as they were close to this third phone people who were okay with that, right? Now they suddenly have an additional service, free of cost, because S opens it up for them. And that improves the market for them, right? As well as for ads, as well as, now G can never approach that market segment.
Okay.
In other words, what I'm trying to say that what I'm trying to hint at is that in your setup, the market is fully covered.
Definitely.
But if there are people out there who are not fully covered, then the strategy by G, because of higher quality or premium quality, may be blocked by in this way. That's what I was trying to get at.
Yeah, so yeah, absolutely point taken very well. Yeah, so I'm looking at a covered market framework, and if I bring incomplete market and then try to impose this closed ecosystem approach, then of course there can be a market expansion effect also. But I have not modeled that effect. And what would happen as a result of that market expansion effect, eventually on the profits of the two firms, that is something which I have to, of course, look into. Yeah. So I know this limitation of my framework, but yeah. So far, again, I'm saying it is good to an extent to understand what essential trade-offs are there when we adopt a closed ecosystem approach. And second, what is the effect of introducing these ads and what we take away? Because this is a very crucial component which is not looked in the previous paper. And what do we take away? That's a first step. Of course, we can always try to build upon.
I especially liked your description and the implication of region 2, quite frankly, yeah.
Gaurav,
Thank
before we, so we have one last question from Uday, but while Uday asks this question, I have to say thank you very much. You followed my brief to the letter. We didn't see any single Greek letter on the slides.
Yeah, I'm bored of using Greek letters. So it was a change for me.
You are a co-author on that paper. Your paper had the most Greek. He was using his language, so he has.
Okay.
All right, Uday, sorry.
Okay, so just because I was tempted to kind of ask, because I am seeing both of you here, Gaurav, I am personally connected, and Nilanjan, my co-author. Okay, so just a curiosity that when you are saying that advertising revenue can be passed on, what mechanism you use in your model? Because we have not seen the model, so we don't know.
Definitely, absolutely. I will explain that. So basically, it's a classical result from the two-sided market literature, in which when two firms are competing on the two sides, so what happens is they can use the profits that they obtain from one side of the market, from the one side, and they can use those profits to basically compete more intensively on the other side. For instance, let's say user side. So they can use that profits obtained from the other side and pass on those profits in the form of subsidizing the users and lowering.
So cross subsidization, yeah.
Okay. Yes, exactly. That's the idea.
Thank you.
Okay, thanks, Gaurav, Nilanjan. Thank you very much. Next time we hopefully see you here in person.
Yeah, I'll try my best.
Thank you.
Thank you.
Actually, why don't we see you in person by being in Bangalore?
Oh, okay. Great.
All right. Thanks, guys. Thanks. Bye.
Thank you. Thank you so much.
So I think that's it. I'll just take a couple of more minutes. I want to thank our guests, our speakers, and all of you, of course. Saturday afternoon at 4:30, you're still here, so I thank you very much. I want to especially recognize Dr. Shubho Ray. He wasn't there in the morning, but he's on the board for the Center for Digital Future. Thank you, sir, for coming. I learned a lot from him. He's a mentor. I want to leave with one thought. As I was going through this day, I was thinking that we've heard so many different opinions about ex-ante, ex-post, competition, anti-competition, etc., etc. Long time ago, I'd read a book by this lady called Diane Ackerman. She's a psychologist and a poet and a philosopher. She'd written a brilliant book. This was when I was in my 30s. One of the things that she had pointed out is that as human beings, we tend to form biases as we hear opinions and we read and we go through our lives. And we tend to take strong positions back because those are the positions of security for each of us. But the higher form of intelligence is to stand between those spaces and be in the space of ambiguity. And, I have a 6-year-old daughter here, and I can say for sure that I love and hate her at the same time. And I have to stand in the middle of that and look at her and myself and my life objectively. And I have to hold those two emotions in my heart all the time for her. And similarly, in research, so I would encourage all of you, and a lot of you are students and PhD scholars, as you hear the opinions today and through your professional student life, try and not form strong opinions, because that's how we get polarized. That's how we get divided and we fight, and the louder whoever shouts is the one who gets heard, or the louder who lobbies is the one who gets implemented, right? But let us try, and this is my idealism coming out, that let us try to use research to look at every side objectively, stand in the spaces, in the ambiguity of things, and go for a better future ahead. Thank you for that. Thank you very much again. Oh, that is intellectual, yes, you're absolutely right.